If you look at the economic data today, it is so significantly consistent with a downturn.
Stocks are in a bit more of a wait-and-see mode.
It feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long.
The Fed is probably going to want to keep its options open to hike more.
The Fed is just well ahead of other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We're costume, we're treating, we're tricking. It's October, is it 31st today? Halloween. I'm going as yield curve control is what we're trying to do. Mrs. Keene said, oh, is that a diet? And I said, yes, that's a diet.
That's how you sold it to her.
And what a choice. She wore black today. Great. I went with sort of a gray motif, but I think it's just inspired you on his toxic brew.
Oh, thank you. I appreciate it. I had to really dig deep into my soul to find the toxic brew. But I will say, if you're yield curve control, I think a little bit more ambiguity would be good, because honestly, I don't know what that means this morning after what we heard from the Bank of Japan.
John Ferro going is the next head of Chelsea football. We'll have to see who that is. Maybe it was Man United. I can't remember which team. Let's go to the business right now. Economics, finance, investment. And in the Western world, we're looking at one thing. They act in Japan. Lisa, let's start there with what the Japanese are making a joke about this. This is not funny.
Okay, what did they do? They basically created more ambiguity around what 1% as a band was. They increased their inflation forecast for this year, next year, and the year after. And then they put this out from Governor Ueda. Uncertainty is extremely high, no kidding. We decided that it's appropriate to increase flexibility so that long-term yields can be smoothly shaped according to different future scenarios. What does that mean?
It means they have to adapt to what's out there, and it's a busted theory. That's what we hear from everyone, and we'll be covering this a lot, of course, into the Fed meeting, which I believe is tomorrow. I'm working a 3-day work week this week, guys, so, cut me some chase. But there are headlines out moments ago. We're going to rip up the script here. We have to do that with Euro area third quarter GDP, and the word is there, contracts.
Yeah, well,
which is a big deal.
Basically, the idea is that Euro area third quarter GDP unexpectedly dipped 0.1%, contracted quarter over quarter versus the estimate of just basically being flat.
Consumer prices.
But that, to me, is more telling. Consumer prices coming in more than people previously expected. This is good news for Lagarde, for Christine Lagarde. 2.9% increase in consumer prices in October versus the estimate of 3.1%.
One of the themes we have here in the next 4 days, and of course the Fed meeting, and of course the importance of Apple's earnings, we'll touch on that as well. Lisa's buying all of the MacBooks for the fam this holiday season.
I did go to Apple Store yesterday, and I had to revamp some of the phones.
I'm
and I have to tell you, I've been giving you grief all year about your prognostications about how Apple, full faith in Apple. And then I went and I actually paid what you have to pay for all of these instruments and all of the different things that they sell you on top of it. And you're dropping big money, and there's a line out the door for everybody to drop big money. I mean, it's the Bank of Apple.
Right there with Bramo, folks. It's a threat to Mark Gurman's employment there with that careful Apple analysis.
Thank you, Tom.
Ferro just emailed it. He's not in Brazil. He made land. I saw he went through immigration.
Oh, good.
They
I'm
let
so
him back
glad.
into the country. But
From your cruise?
Yeah, it's like Miami. He's getting the feel. He may move to Florida, taxes.
Can you imagine?
And all that. Let's do a data check right now for you on television and radio. Green on the screen and more green on the screen as well. And the VIX under 20 to me is important. 19.35. And the yield front, 5.02%. Two-year, 10-year, 4.82. 30-year bond under 5%. Crisis over. 20 beeps on the 2s, 10s. And we won't do the real yield yet. It's giving me a nice number. Dollar. And we're going to go to yen here, which is very important. At the yen, rounded up, a 151 yen, weaker yen back 40 years. And euro yen, I don't want to slow the show down. I'm gasping here. We could trick or treat. It was too many baby Ruths. The euro yen, 161 on euro yen as well. This is serious. We're making jokes about it, folks, but this is really disarming to global finance.
I want to give you a sense of what some of the important indicators are going to be today. 8:30 a.m. we get U.S. Employment Cost Index for the third quarter. It's the drumbeat to what we get on Friday. Do we see that sort of disinflation of just wages, especially after what we saw with the UAW over the past couple of days? 9:30 a.m. Secretary of State Antony Blinken, Defense Secretary Lloyd Austin are testifying at a Senate Appropriations Committee trying to argue for more money. The split between Senate Republicans and House Republicans, key right now, especially with the new House Speaker. And we get 29 companies reporting earnings today. before the bell, we hear from JetBlue, Caterpillar, Pfizer, the whole healthcare question about whether there was a bubble in healthcare during the pandemic, and now it's sort of a reckoning. But AMD after, speaking of what we've seen in the smartphone indicators that I just purchased yesterday.
Trying to give you smarter coverage on earnings as well, not only looking at earnings, but looking at revenue dynamics. We'll do that today, and of course with Apple November 2. Right now, he is back in Israel, in Tel Aviv. Oliver Crook joins us for a brief. It was really distressing to see the headlines overnight, Oliver. Can I state this morning, Oliver, in New York, that there are battles in tunnels?
Well, Tom, it's a complicated question because a lot of what is happening now in the ground offensive, which we understand is expanding, that the Israelis are not really being very transparent about the mechanics of what is happening now. So what we've had to do very clearly and very closely watch what we're seeing from the IDF and the comments that they've made in the last few hours. And what they have said is that they're continuing to expand around northern Gaza, and so not just in one location, but a number of different locations. They say they have been killing dozens of fighters that are coming from tunnels, so you have to assume that that is going to be part of their game plan there. And they say that more than 800,000 people have fled the north. And remember, this is all part of the ground that they laid, really bisecting the area of Gaza and focusing most of their fighting in the north there. They've also updated their hostage figure. They say there are 240. They say they've also recovered one hostage, an Israeli female soldier who is in good health and good condition, and they said they were able to get some intelligence from. But again, as this rolls on, and again, it's a new dimension for there to be a new spark and a new impetus for more escalation.
Ali, Syria, Lebanon, Yemen, there are new fronts, although they aren't necessarily in extreme forms of fighting just yet. How do you sort of reconcile the idea of a non-escalation with fighting in these places?
Well, this is the question. And again, it's in Syria, for example, the Israelis have been striking. So too have the Americans. The Americans have struck at least 2 locations because they are coming under fire. So that is one place to look at. Lebanon, we've talked about a great deal. We've talked a little bit less about the West Bank, where we understand from Sunday to Monday, 6 Palestinians were killed by Israeli forces there in terms of skirmishes. But then a really important story out overnight from Bloomberg reporting about this skirmish in the southwest of Saudi Arabia with Yemen, with the Houthis, that killed 4 Saudi Arabian soldiers, and that now the military in Saudi Arabia is on high alert and apparently also intercepting missiles that are going over Saudi territory. So again, it's your pick of all these different points where you can see the sparks emanating from.
Well, the span of tension in the Eastern Mediterranean. Oliver Crook in Tel Aviv, thank you so much for our early morning brief here. Now to consider the finance and investment of where you are into the Fed meeting and into year-end. Russell Kosterich joins now, portfolio manager for BlackRock's Global Allocation Fund. Russell, you're beginning to write up a year-end report, a year-end view. It's going to be 17 pages. What do you do after page 2? I'm fascinated how you construct a view forward to 2024.
Well, I hope it's not going to be 17 pages, Tom. No one's going to read that. Look, this has been an extraordinary year, and I think it's not just the fact that we've seen a remarkably resilient U.S. economy, which, by the way, we think is going to continue into 2024. It's been the move in rates, the market's resilience for the most part with that move in rates, and I would say the continued success of a small group of companies that have really defined the U.S. market for much of 2023.
Russ, Bill Gross started in the mailroom at PIMCO a few years ago, the Pacific Investment Management Company, literally clipping coupons. Folks used to take a bond and scissors and clip the coupon, and you get your interest payment. Are we clipping the coupon forward 12 months, forward 13 months, or are we total return?
I think it is part of the total return. I mean, this is an excellent question. When we think about what we've been doing in the fund, we bought a lot of bonds over the last few years. We bought a lot of credit back in 21 and 22 when spreads were wide. We've been holding that. And, again, it's not that I think right now you want to pile into any particular area, but opportunistically, whether you're looking at securitized, EM, the short end of the curve, there are opportunities. And exactly as you say, if you're thinking about building in a 6, 7, 8% yield into parts of the portfolio, well, that gets you part of the way to your goal. And that's something we've not been able to do really since before the financial crisis. It's a different way of thinking about the portfolio, let's say 5 years ago when you were getting nothing on the front end of the curve.
How much are you going into bonds in favor or in lieu of stocks, especially globally, Europe, other places where growth is a lot less certain?
Well, just to be clear, we are still a little bit underweight bonds. We're a little bit underweight duration. That's partly a function of the fact that there is a lot of uncertainty about the Fed, although we think that they're probably done. But the main concern, I think, on parts of the bond market, particularly the traditional part, is really about the premium you're getting, the term premium, to go out on the curve. And that is as much to do with the supply and changing demand dynamics as it does about inflation or the Fed. So I think you still want to be a little bit cautious on long duration bonds. On the equity side, we're pretty close to home now. We're close to our benchmark. I do think you've got an opportunity if events don't erupt in the Middle East for year-end rally. But right now, the byword we're using in every meeting is idiosyncratic risk. In other words, rather than focusing on taking a big equity bet, picking your spots, looking for the parts of the portfolio that align with long-term themes, rather than just saying, let's go out and buy lots of stocks.
You said something very interesting there, Russ, that this has more to do in the bond space with supply than it does about inflation dynamics or growth, at least in the U.S. Yesterday, we got a net borrowing estimate from the Treasury Department that was slightly lower than what people were previously expecting. Part of the reason why some people are saying you're seeing a bit of a bid into bonds today. You're seeing yields come in. How much is that the entirety of the story behind the yield move that we've seen in the U.S.?
I think there are a lot of dynamics going on. I don't think you can ever attribute to one factor, but I do think you're right to point it out. And it's an interesting, sort of story because 5 years ago, no one was paying attention to these releases. I shouldn't say no one, but it certainly wasn't moving markets. And I think, as you correctly point out, this is likely to move markets going forward because when you look at the move we've had, people are worried about how much of a premium do you need to own the long end of the curve, and that's still an open question.
Major topic at BlackRock with BlackRock's success. Is this a time for active management, Russ Kosterich, or do you shelter out in passive portfolios, index funds?
Look, there's always a role for passive, and there's a reason that has exploded as well as it has. But I do think this is an opportunity for active, and I'll go back to the fact that the portfolio is probably going to look different than it did in the post-GFC world. In that world, you could take really, two allocations, U.S. equities and U.S. ag. You could put them together. You get a remarkably good return for more than a decade. I think now you need to be more dynamic. You need to think about the role of carry. You need to think more about stock-specific risk.
Thanks for the brief. Russ Kosterich of BlackRock as well. We have breaking news here 20 minutes ago on EU data. This has been widely anticipated by ECB authorities, including, Lisa, you mentioned correctly, Lagarde. Andrew Langley summarizes for us at Bloomberg News. Euro area inflation to its lowest level in more than 2 years. The economy shrank. I'm gonna editorialize and call that stag disinflation. Well, I think that's sort of where I am.
What I find interesting,
Mr. Summers would be like, Tom, don't say that.
What I find interesting is that the euro is gaining versus the dollar on this report, which really raises the question, what exactly are people looking for? Are they looking for growth to invest in a currency, to invest in a nation?
Yeah.
Or are they looking for just some sign that inflation is coming off the boil? And that, to me, the fact that took the preeminence in terms of the response of markets was really telling.
I'm going to go to what you had in the brief today, which is the ECI index, which I really lean on, folks, wages and benefits combined. And I don't know what the number's going to be, but if you establish a disinflation vector in the wage package of America, that gets your attention. Further disinflationary trends, as we hear from David Rosenberg and Edward S. Hyman.
Wages haven't really led throughout all of this. They've actually picked up more over the past year than they had. Yeah. What I find interesting is, do they continue to disinflate as much as people say, especially after the strike ended over in Detroit, especially with the losses that some of the companies are saying they're going to incur?
As you awake in America for global Wall Street, take out the dollar, euro, yen. Stunning over a span of 30 plus years. I have a 161 euro yen. We'll talk about that through surveillance this morning. On radio and television, this is Bloomberg.
concerned are you that Japanese buyers in particular, big corporate debt buyers in the U.S. are going to pull back, especially with some of the adjustments we're expecting from the Bank of Japan?
So we think that risk so far is moderate, but we do have to watch it. Again, the return on a hedged basis for a Japanese investor into U.S. corporate credit is not good. So we do need to watch that. We do need to see still if the flows on an unhedged basis continue. Our base case is that they do, but I think that's something subject to what we might see this week.
Andrew Sheets, always good, global head of corporate credit research at Morgan Stanley, with a piercing conversation yesterday. Good morning, John Ferro on assignment. He is back in the country. Good to see that from his cruise, and we hope to get him here in the next couple days. Lisa Abramowicz and I here for Halloween. Lisa's going as a toxic brew. Somebody emailed in, they said, do you trick or treat together? I said, nah, we don't,
Toxic brew and yield curve
it's just too
don't
much.
go well together.
She takes, it's like Leonard Cohen's song. You take Manhattan, and
and you take what? Brooklyn.
Brooklyn.
Yeah. How often you go there?
I went a couple of years ago. Actually,
oh wow.
The bridge was brand new at the time as well. Futures up 9, Dow futures up 130. I got a VIX under 20, 19.37. John Ferro out on Twitter yesterday highlighting the Dow Jones Industrial Average.
Yeah, with a real
is
burn.
a benchmark worth watching as well. The dollar flat. Let's go through those levels right now. Yen 151 rounded up. That's stunning on dollar yen. Euro 106.57 off the euro disinflation and contraction we just spoke of. Let us look at the chart right now of euro yen. This is what the adults look at. For those of you that lost in translation, pick the maroon carpet. Okay, euro Japanese yen is a depreciation of the yen of a stunning 40% from 2012. The dollar trade weighted, including all the other indices. Thank you, Deutsche Bank, for this. Up 46%. Dollar strength that President Trump used to scream about. We are living it right now. A brief from Mark McCormick, Global Head of Foreign Exchange and EM Strategy, TD Securities. Mark, I want you to explain to our audience why a super strong dollar from 2012 and a super weak yen is disturbing.
Well, I think what it does is it just shows the massive divergence you have between central banks. I think one of the things that you can unpack is there are certain currencies that care about growth. There's certain currencies that care about commodities. There's certain currencies that care about different relative central bank functions. The thing that the yen cares a lot about is the 10-year point. If you look at euro cares about the 2-year point of the curve more than, say, the 10-year. And if you take the combination of what we had, and this is one of the most important things going on in FX, is the relative terms of trade shift. Japan is also a massive importer of energy and other commodities. So you take the commodity story, you take the rate differential story, right, and now you take the aggressive bear steepening of the U.S. curve since the summer, and you've got basically a trifecta of things that will weaken the yen quite considerably unless the BOJ does something.
Well, to the trifecta, let's go to Mundell of Columbia. I mentioned this with Vice Chairman Clarida the other day. He will join us, folks, for our special Fed coverage. Look for that. Is that tomorrow?
Yes.
It's tomorrow. The Fed meeting is tomorrow. My people have just briefed me. And Mark, I'm looking at that, and I want to echo what I talked to Professor Clarida about, which is something has to give here. When something gives, what is the instability our audiences should be worried about?
Well, I think in the context of the yen, what needs to give is the currency itself. As you mentioned, there is a very interesting policy mix where fiscal policy is actually quite favorable in terms of growth. Also, inflation. You see the BOJ is expecting higher inflation to kind of be a bit more sticky, I think, than markets are looking for. And they've also basically said we don't have a cap anymore. It can go above 1%. So I think what they're trying to do is synchronize themselves a little bit, which has been U.S. yields rising, which would contain the weakness in the yen. But this is not a policy mix that is coherent, and it is no longer sustainable. So I think a big thing is what we're going to see is things are going to change. They will change abruptly. But I think the movement that we had overnight where they said there's no longer a 1% cap is actually quite a significant change, but it will take time for this to work through the market. So again, I'd say that the thing that needs to break is yields need to be higher, yen needs to be stronger. It's just going to take more time because we also need to see a peak in the U.S. yield story, which again is not even about the Fed anymore when we talk about the 10-year yield. It's more about supply and demand for 10-year bonds.
This is a big mishmash. Do you have a sense of what the response mechanism from the Bank of Japan is, what the lines in the sand are, what they're sort of looking at? I mean, we were talking about some of the opacity that they put forward overnight.
It's very tricky because I think obviously most central banks, it's very common language at this point. They care more about the currency movements. So the yen has not been as volatile. So it's, as you can see, we have not, the report came out this morning, like they did not intervene last month. So I don't think there's a red line per se. I think they're all kind of doing what everyone in the market's doing. They're very confused about the drivers. They're very confused about the actual themes in the market. FX has become very challenged, I think, for many people. So I think the line in the sand is you're kind of thinking it's loose fiscal policy, loose monetary policy, weakest currency on record. It deviated from our longer term models by magnitudes. Our longer term fair value model in dollar yen is in 120s. So what you're kind of looking for is like the pressure points that will cause these things to break. And again, I think a big part of it is U.S. data needs to roll over. U.S. yields need to come down a little bit. And the BOJ, I think the one thing that we're very out of consensus on is we are looking for them to move out of NIRP next year because of the wage pressure we're seeing in Japan. Right around the Shunto wage negotiations, we should see higher wages. And as a result of essentially higher wages and higher nominal rates coming up, we should see real rates in Japan move substantially in their favor versus the U.S. next year.
When you take a step back, there's a question of slowly or all at once. And you were saying it will be all at once at some point. How disruptive is this going to be at a time when so many people were talking about Japanese flows underpinning or basically suppressing yields globally and really keeping things a little bit more in sync?
Yeah, I think that's a big component because I think since the summer, since the BOJ let the kind of opened up the yield curve control, the suppression they had on it, we have seen term premium rise across the world. We have seen the U.S. 10-year rise. So I do think that there is a blowback here that's happening slowly behind the scenes. Right. And again, I think a lot of people will make the point that the 10-year yield is now advanced above Fed expectations for 2024. It's above data surprises. It's above U.S. data trends. It's no longer reflecting the correlations we saw in July. So I do think that the BOJ and the fact that they're kind of moving out of it, obviously quantitative tightening has a component of this as well. But the BOJ does have the ability to kickstart, rises in the U.S. 10-year as well.
Bring up this board again on television and radio. I have to review you this. I didn't do this. Simon did this in the control room. He's been reading Michael Rosenberg on foreign exchange. Bring up that board again here. Yen, 151. Weak yen. 2-year yield, finally above zero. 10-year yield, almost 1%. Those are unimaginable numbers to pros. Mark, is this going to end stochastically? I talked to Martin Feldstein about this years ago. Like Loonie, let's go to Toronto Dominion Bank. Loonie goes up 138, you get up to 142, and it gets fixed. Is that where we're heading, where the system just fixes itself?
No, I think the system's quite dynamic. I think that's the interesting point. Like we run a variations of lots of different types of tools and models and different things. We're trying to understand what's going on in the market. As I mentioned, the things that are driving a weaker yen are fundamentally based. They make a lot of sense. And again, the commodity story behind the scene is quite important, especially from the handover to last year, because what it does is it eliminates the trade surplus, and the trade surplus plus the current account plus the balance of payments. That is FX. Essentially everything we talk about every day is trying to think about how do we predict the balance of payments. So for the yen, I don't think any of this is stable. I think it's a very unstable equilibrium. Even the shorter term models that we look at that we use for trading ideas, dollar yen should be at 145 based on rate differentials and equities and risk and these kind of things. So it's even deviated now because markets are looking for a trend to trade, and dollar yen is the only one that makes any sense right now.
3 people just drove off the Garden State Parkway. There's your Global Wall Street brief on foreign exchange. If you only understood half of that like I did, he's Mark McCormick of TD Securities. Can I talk about the greatest ad campaign ever?
Please.
I remember when Halloween changed, and it was like kids. It was like fun, kids and all that. And the people out in Golden, Colorado invented Elvira. And now, you look up, there's a survey here of the 3 top things for Halloween. It's like Kit Kat bars, duh.
Yeah.
M&M's, duh. I like peanuts is what I like.
I agree with that.
Okay, and the third one is Coors Light. And Coors, think about it. Coors beer changed a holiday in America with Elvira and all that.
To take it from kids going around and getting candy to the parents sitting there getting drunk as they hand out candy. Is that what you're saying?
I'm Tom Keene. Bloomberg Surveillance. Who's with me? The queen of Halloween, Lisa Abramowicz.
Oh, yeah.
Bloomberg surveillance. Barry Ritholtz emailed and he goes, "Are you really going as yield curve control?" I said, "Yes, Barry." I was going to go as gamma, but that's so.
And how does your outfit change to be
yield curve control? It's really good. I just go as a Japanese boy band, and everybody understands what I'm doing. I mean, it works out. It works out great. It's like BTS except Japan. I mean, it works out. Futures up 9, Dow futures up 138. We're under 20, 19.36 on the VIX, and we've got some serious news. I'm gonna truncate this because we got to go under surveillance before we go over Jill Moek. But the answer is I'm sorry, everybody's fighting the last war and things are shifting. Pay attention today, into the Fed meeting tomorrow, into Apple earnings on Thursday. Bramo, 2 MacBooks in the last 24 hours. Ordered the new toys.
Well, let me tell you, those things are expensive, and all the different plugs, they charge you for everything. It's ridiculous.
Yeah, where do you get the AirPods refill? Under surveillance with the queen of Halloween.
All right, under the surveillance, shifting gears quite a bit. This morning, Israel striking targets in Lebanon and Syria as ground operations in Gaza are expanded. An Israeli military spokesperson saying, quote, "Tanks and other vehicles are moving through northern Gaza looking for Hamas and engaging with their combatants. This as the humanitarian crisis worsens." An Israeli minister telling Bloomberg that a greater number of supplies would be allowed in from Egypt starting today or tomorrow. Tom, there are a number of different points here. First of all, the humanitarian catastrophe is deeply upsetting. It's unmeasurable. And it's something that we're watching unfold in very much real time, in pictures, on social media, et cetera. And a lot of it has been cut out because of a lack of electricity. But then there's a definite opacity also about what the ground operation actually looks like that Israel is waging.
I think we're redefining the word terror. And I'm going to leave this to experts as well. I read every word of Robert Gates, an American former Secretary of Defense, CIA, in the new Foreign Affairs. We'll talk about that later, but the immediacy here of what we think, you think, I think, everyone thinks, and expanding it out to a broader frontier, a broader war. Witness what Oliver Crook said about Yemen and Saudi Arabia overnight.
And that's going to be a story that we're going to be following for quite a while. We've been talking about this all morning. The Bank of Japan easing its grip on long-term government bond yields in a modest policy tweak. The Bank of Japan saying it will take a more flexible approach to controlling yields on 10-year government debt, saying the previous 1% level is now a reference point. Right, whatever that means. The yen extended declines against the dollar this morning, perhaps because people expected more. But you do see that 10-year yield climbing pretty significantly.
Do they have dots?
It would be a, impressionistic sort of, dot experience.
Like, a yen's an experience. I don't.
To that point, though, we do have dots in terms of their inflation forecast for this year, next year, and the year after. And you do see inflation, core inflation, climbing above their 2% target for 2023 and 2024, but not for 2025. But how this is really influencing some of these tweaks is going to be interesting, and how this percolates out into other markets.
What else do you have?
X, the platform formerly known as Twitter, is now valued at $19 billion. That is less than half of the $44 billion that Elon Musk paid last year. X has seen a 60% drop in ad sales, largely due to looser content safety rules. Musk's plan is to shift away from advertising toward paid subscriptions. But so far, less than 1% of users have signed up for the monthly premium service. This has been a big question mark. There's a lot of debt tied to this. But this is also, it used to be the town hall where people would really voice their opinions, their concerns, their news,
come on, get the surveillance cork out. Put it
no,
in my
I
mouth.
want to hear what you have to say.
No, you don't, because I'll go in the timeout chair. I mean, they won't like what I say. And it's just garbage. I can't, just shut up, Tom. Let's move from Twitter here and the useless value of X. I didn't editorialize there. Quickly, earnings. While you were talking, earnings came out. JetBlue craters, like other airlines here. Caterpillar up 3%. Caterpillar with a nice pop here of industrial America. We're going to dive into that as well. But again, this is about pricing power at Caterpillar. JetBlue does not have pricing power, period.
They revised lower their full-year revenue forecast to 3 to 5% of a gain. They had previously seen 6 to 9% of a gain. They also saw a bigger adjusted loss per share in the third quarter of 39 cents versus 28 cents. But ultimately, how much is this domestic versus international? How much is this because of what we're seeing with oil prices and fixed costs? And how much is this just in general? People have gotten it out of their system. They're done. And frankly, the experience hasn't gotten that much better. In fact, it's gotten significantly worse. So people aren't flying as much.
And the other thing here is to talk about industrial America. I've got 109,000 employees at Caterpillar. Caterpillar, folks, with the CFA is widely followed because in level 1 CFA, you tear apart John Deere and Caterpillar's accounting statement. So we look at Caterpillar, and I'm sorry, I got a 242 out to a 250 here. And if I look at the margins, you come down the income statement of profitable Caterpillar, it's terrible. They're doing, like Gartman says, they're dropping things on your toes and it hurts. They're making 22 cents per dollar on the EBITDA line. The net income is, I'm going to say, double Ford at 15%. This company's making money.
So there are a lot of questions here. First is the idiosyncratic stories and the specific micro stories behind why this company is doing well. But then there's also a question of, we saw services inflation. Is it cooling a little bit? And are we seeing a reinflation of goods as people go back to stuff, as people build stuff? And that, I think, will be an interesting macro.
The arch theme is disinflation in goods, and then there's services to worry about. Maybe in Europe, it's a different story. We get a brief today from the wonderful Gilles Moek, Chief Economist, AXA Group Paris, Head of Research at AXA Investment Managers. Gilles, just honored to have you on with us today. How happy is Christine Lagarde this morning?
She probably feels vindicated because she was very cautious last week, and the ECB has, I think, quite clearly changed tone. I think changed tone more than what could have been expected. And the slew of data we had today is confirming that definitely monetary policy needs to be cautious because we have good news on inflation. Disinflation is really being confirmed. It's not just about headline, but also about core, which obviously matters more to the ECB. And unfortunately, this comes with a price. And the price for this disinflation is an economy which is not doing well. Right. So we've had a small contraction in GDP. So yeah, ex post, I don't know if the Hawks were very vocal at the meeting last week, but any sort of cautious line from the ECB is supported.
Tell us of the relative dynamism, to steal from Ned Phelps, a laureate of Columbia. Tell us about a dynamic America in a Europe maybe less dynamic, where Lagarde has fewer degrees of freedom to move with disinflation, with what I'm calling this morning Euro stag disinflation. With that, does she have fewer choices forward?
I think one of the issues the ECB has is that all this comes with a pretty steep depreciation in the euro, and that's a particular challenge for the eurozone, which is a more open economy than the US. So, if you're a central bank and you see that core inflation is falling, and the economy is softening faster than the US, quite clearly, you might be tempted to say, look, not now, but maybe in 2024, I may cut a bit faster than the Fed. The problem, if you do that, is that you're going to trigger a further depreciation of the currency, and you're going to fuel imported inflation through core. So that's a significant issue for the ECB. And there is another problem, I think, which is that politically, I think the Governing Council is not yet ready to contemplate actually a change of stance. There is a constituency of hawks who are not now clamoring for more tightening, but who will probably resist any quick change of stance, arguing that the ECB has been too slow to react to the surge in inflation. So my impression is that at the Fed, the sense of consensus is probably higher within the FOMC. There are nuances, of course, but there seems to be a stronger consensus. It's going to be hard to build at the ECB in the same way that it has at the Fed.
You said that Europe is paying the price for disinflation. It doesn't seem like the U.S. is paying the price for disinflation, which raises a question of whether it's real, right? And do you think that in some ways the disinflation, God, I'm gonna get crushed by Tom later, is the disinflation more transitory in the U.S. than in Europe? Basically, are we going to see a reinflation? Is there a greater chance of that in the U.S. because we're not paying the price for a slower pace of inflation?
For sure. This resilience has it's become a cottage industry to try to find reasons for this resilience in the US, but it's day in, day out, the accumulation of data is quite obvious. I think one key issue the US has is that for the time being, there is still no sense that the labor market is really lending. Wage growth seems to have slowed down, and the ECI today is going to be very, very important to really make sure of that. So that's a relief, but there's just so much job creation at the moment that you could be excused for being a hawk at the Fed right now and say, look, we're definitely not in the market for cutting rates anytime soon, and there's the possibility that yes, they will have to hike further. I think the situation is different in Europe. We have what we should have expected all the time, which is that when you bring interest rates, policy rates to what is twice now, what is the upper end of what is estimated to be the neutral rate in Europe, well, it triggers pain. And the pain is plain to see. It's not all because of monetary policy. We have our weakness. We have, in particular, the legacy of the energy shock that we had a year ago. That has nothing to do with monetary policy, but clearly it's not helping.
I do have to wonder what's exactly driving borrowing costs, though. Is it central banks or is it something else? In the U.S., I was surprised to see yields lower, substantially lower, even with the Bank of Japan tweaks around the edges. A lot of people just pointing to the refinancing agreement and the fact that the Treasury Department is actually coming in a little bit below estimates of how much they're going to have to borrow in the third quarter. How much is this the whole story right now in terms of the incremental gains or declines when it comes to borrowing costs in the U.S.?
I think, honestly, we've had a lot of movements over the last few weeks, which to me tend to be pretty technical, and it seems that every time the US gets close to the 5% psychological threshold when it comes to 10-year yields, it triggers some sort of buying in the market, and things improve a bit. And then yes, you've got those news around the borrowing requirement, and maybe the fact that the Treasury is going to issue more bills and a bit less on the long end of the curve. That may also have explained some of it. I'm actually, from a fundamental point of view, I'm getting quite interested in the current debate on the neutral rate, where the neutral rate is in the US right now. And it's fairly easy in the US to build a case for the equilibrium rate having risen. And the resilience of the US economy to the current tightening would be one of the pieces of evidence towards this high equilibrium rate. You don't have that evidence at all in Europe. And our problem, I would say, as usual, is spillover, contagion. There is no reason why long-term yields should be as high as they are probably right now in the Eurozone. But we're getting some contagion from the US.
Gilles-Marc, thank you for the brief. Greatly appreciate it. If you're just joining us, shocking news from Europe as we see disinflation and also contraction as well. Lisa, this is really the heart of the matter, and I've seen it in the zeitgeist in the last 72 hours, which is the level of restriction away from the actual Mike McKee data. And the answer is we're talking 5-ish%, and adults are looking at how the markets have moved, and they throw 200 beeps on there, where it's a 7% Fed policy right now, not 5%, because of these adjacent moves in the market.
And what you have seen, in addition to this idea that you are seeing a slowdown on the edges, and then even more so in the U.S., despite the headline data, that constriction is bleeding over into credit, and you are seeing spreads start to widen out. You are starting to see credit reflect the potential that some of these companies are going to have a weaker business model if they've got to pay that much higher borrowing costs.
We're going to have to see on that as well. I've got lots coming up here, but I really want to go back here to Japanese yen. It may be removed from some of you, not part of global Wall Street, but we're all getting up to speed here on what's going. Here are two currency pairs. Dollar yen, which was 95, 110, 120, now out to 151, rounded up, weaker yen. And euro yen, which is what the pros look at, to a stunning 161. Coming up on Japan as an emerging market, Damien Sassower will join us with Bloomberg Intelligence. The television star Damien Sassower will join us. He's like, I think it's like saying, see you, Tom. This is Bloomberg. Good morning.
What we we try to stress is not that China is uninvestable per se. It's that you can't invest in China like you did, 10 years ago, even 5 years ago, because the risks are so much more dramatic. What a lot of large asset managers in particular were used to for many years is, they invested in their big tech companies. They loved their Alibabas and their Tencents, and they were just used to just collecting dividends on a regular basis and watching the stuff go up. That era is completely over.
Smartest guy in the block. It's a big block in China. Leland Miller, China Beige Book. I can't say enough about the gentleman from the University of Virginia. Leland Miller is encyclopedic on the granularity of China, and it was good to get that brief as well. Lisa, we've got an important guest here. I don't know, is Japan an emerging market this morning?
It's quite the opposite, I think,
40%
based
depreciation
on
from 2000.
some of the growth that they're experiencing. But in China, we've really been focused on just the state of the economy and the lack of certainty around that. The latest data out of China really signaling massive weakness, sort of fragility in this nation's economy, both manufacturing and non-manufacturing PMIs for October, falling below estimates and down from a month earlier. This has been the perennial question. Just how weak are they? Damian Sassower, haven't seen you in a long time. Chief Emerging Markets Credit Strategist.
Happy
Bloomberg
Halloween.
Intelligence. Happy Halloween.
You sick
I'm
of
going
me yet?
evidently as Toxic Brew. But I'm curious from your vantage point, how weak is this economy?
It's pretty weak. It reiterates the fragility of the economic recovery in China. I mean, we knew it was going to be a weak number. We had the 8-day golden week leading in the beginning of October. But at the end of the day, for manufacturing, the manufacturing PMI to slip back into contraction, for non-man to slip back into weakness, not quite a contraction, it's a pretty big deal. And on the small firm side, which is responsible for most of the employment in that economy, it's terribly weak, way into contraction. And, things are just not getting better. We expect now 5.2% GDP growth this year, 4.5% in 2024, and we expect a rate cut before the end of the year.
Does this matter? If ultimately the question hasn't been how weak is the economy, the question has been how much firepower are Chinese authorities going to put behind it? Is that really just squarely the question and continues to be after they have made initial moves, but some people are saying maybe not enough?
Well, Lisa, we talked about this yesterday,
we
right?
Did.
I mean, the 130
You were here
billion.
yesterday?
I was. Where were you? You weren't here?
No, I was on sabbatical.
Okay. $130 billion expansion of their fiscal deficit into year end is kind of unprecedented from a China perspective, right? And the fact is they're going to need to cut rates in order to kind of smooth out liquidity in the market in order to digest all that debt they're going to have to issue in order to fund that, right? So, it's going to be an interesting year-end turn, I think, in China, which has now, quite frankly, become a funding currency on par with your friend, the Japanese yen. And so, that's really what we're talking about here. And I think some of the measures, sorry to cut you off, Tom, I just have to say it, that the BOJ have taken today.
Ferro. Continue.
Carry on.
We're priced in by the market. So all this hype about 160 euro yen, $155 yen, I think, look, you see the market's already bringing it back a bit. Levels are still really low in Japan, and rate differentials are still really wide when compared to Europe and the US.
I want you to explain how you make money in the Damian Sassower world with currency depreciation. This ever stronger dollar. If we had President Trump now, he'd be apoplectic about the strong dollar right now. I've got FX depreciation in a frontier economy like Japan. I've got FX depreciation in the EM like Indonesia. You pick the country better than me. What in God's name does that do to my EM total return?
Right, total return is exactly the point. There's an interest rate component and there's a spot component. Spot is simply movement in the currency itself, which kind of reflects the theme of the day. Maybe it's growth, maybe it's inflation, what have you. But it's that interest rate return which is key, right? So you're not getting much of a return, in places like Japan and China and a lot of the low-yielding Asian blocs. So, they have tended to be good funding currencies relative to the high-yielders in Brazil, Colombia. Notice I'm using both of those economies because Colombia announces on interest rates today. Their policy rate's 13.25%.
So what do they do? Okay, stop there. This is, folks, this is why we have Damian on, even when I'm not here. They have a rate of 13%, which everybody out here understands business doesn't run. I get that. What do they do besides call 1-800-GORGIEVA and say, help us? What's their choice set?
I think the risk when you're investing in a high-yielding economy like a Colombia is that it's very liquid, right? And once you're in that economy and clipping that coupon, getting out isn't as easy.
You're addicted to it.
Getting out isn't as easy. It's just not like overnight. Like you can sell your Colombian peso. get your dollars back. I mean, it takes time, you know. There's a T plus something days until you can actually pull your money out. And in that amount of time, if your block is big enough, you can move the market quite considerably.
Okay, fine. But then does that mean we're towards, pick the date, 1992, 1994, the August of 1998? Are we getting near a point where EM, there's not enough oil in the engine to make the Damien Cesar world go like the Detroit Lions 6-2?
Lisa, Tom's been reading my research because he knows that this reminds me a lot of the mid-90s period. I mean, it really, truly does. To me, it's just my opinion.
I don't know what I'm talking about, and it does.
Things are breaking offshore. I mean, I say it all the time. In frontier markets that no one cares about, like Nigeria, Kenya, Ghana, currencies have been devalued by 50%. Things are breaking, but we just don't feel it here yet. And so this reminds me a lot of the mid-90s, but this time we're not as close to it as we were in the mid-90s when Asia started to roll over, Thailand, the Asian debt crisis, the tequila crisis of Mexico, et cetera. But nevertheless, it does feel to me to be quite similar.
Is there a long-term capital management? I mean, if you're going to go to the mid-1990s and you talk about something, if you're going to talk about something breaking, always the gloom. He was basically leading it off.
I don't like to think so, Citadel. No, I'm kidding. I'm joking. I never said that. But what I would say is, look, there are big firms out there that are not necessarily your traditional hedge funds, your traditional banks, your traditional players, non-bank financial institutions, whatever you want to call it, shadow banking, et cetera. Yeah, there could be some pockets of distress that bubble to the surface when things get really tight. And I think what we're seeing in cross-asset vol right now, Lisa, is the market valuations are finally responding to tight financial conditions. And we see that just alone if you look at rate vol, which is trading at a premium to equity volatility.
Honestly, we've been trying to grapple with what would break given how quickly yields have gone up. And we're talking now about the Bank of Japan potentially abandoning yield curve control. We're talking about the potential for economic growth in the engine in China rolling over. Jeremy Stein, the former Fed governor, who is very colorful with his words, said in a recent Bloomberg article, if you had told me 2 years ago that the Fed would hike by this much in such a short time, I would have said that they would leave dead bodies littered across the corporate credit landscape. I really don't have any good story to explain why things have instead remained so resilient. Are you saying that they're not? It just is taking longer.
First thing I'm saying is I have to apologize to Ken Griffin because Citadel is a wonderful company and they employ a lot of my friends and they invest really well. And I just want to apologize. I just got this vision of Ken Griffin calling me now. Anyway, no, I'm kidding. So the question was, I think, the resilience of investors in this environment?
Just in terms of when you talk about the emerging market complex, the fragilities that you're seeing, do they look akin to what people were expecting when you raise rates by 500 basis points in less than 2 years?
Yeah, no, I think so. I've been calling for this for a while. I think a lot of my peers have been calling for it. You can't really invest in EM local until the U.S. really starts to cut. And the U.S. seems to be on hold for a lot longer. And you know, that runway seems to be expanding by the minute. So, you know, I think that's why EMFX is on its back. EM local rates, I mean, they've given up so much performance in just the last month alone. And I think it's justified.
Right. Robert Mundell, like 2000-ish, dollarize. He told Canada is an EM to dollarize against the United States. Should Argentina dollarize now?
They don't have the ability to.
They don't. Please
They generally don't have enough dollars in the system to function, and that's what dollarization means. Peru's a little bit of a They don't have dollars.
They don't have the wealth.
Right. Correct.
They don't have the balance sheet. When people say the United Kingdom is poor, it's about wealth.
Correct.
Strange word.
Correct. And you know what I've been looking at, which is really interesting, just taking you back to Japan and looking at domestic household wealth. You want to talk about domestic households in Japan are funding in local currency and investing abroad. They all have little, trading accounts set up where they're basically buying dollars. They're buying Brazilian real. They're buying Indonesian rupiah in their PAs, in their personal accounts right now as we speak. And those volumes are exploding and have been for some time now. And that is just indicative of what's going on in Japan, that they've kept yields so low for so long that is embedded in the sentiment in how these households have to operate and invest their money in order to kind of pay for things.
But the distinction here is the people of Japan and other nations are wealthy, quote unquote. This strange word wealth, folks, versus Argentina doesn't have the underlying wealth to dollarize.
That's correct, yeah. No, I mean, that economy would not be able to function, would cease to function, if they tried to dollarize. I don't know how Malay would be able to do that. Malay is obviously the one who is a proponent of that. We have a big election coming up in the next few weeks in Argentina. But I mean, there's also, it looks like it's going to be Sergio Massa again, which is unbelievable. It's more of the same in Argentina. How does the IMF continue to get behind them?
Did you, I mean, you're big buds with Ken Griffith at Citadel. Did you go to Disneyland in Tokyo?
I didn't. I would have liked to. I'm definitely not getting the invite for next year. No, I don't think so. Not after today.
Damien, is he with us tomorrow as well? It's like Every Day with Damien. I feel like I'm on The View. You know, I got to do my Whoopi imitation.
Good luck with that.
I feel like I'm in The View here.
Next Halloween.
Damien, thank you so much. Please come by tomorrow as well. Damien Sassower, brilliant on emerging markets. He's with Bloomberg Intelligence. Markets on the move. Futures up 9. A nice tape here early on. Again, yen weakens. Emily Rowland of Boston next.
If you look at the economic data today, it is so significantly consistent with a downturn.
Stocks are in a bit more of a wait-and-see mode.
It feels like anytime there's a part of the market that gets a little bit of leadership, it can't sustain it for that long.
The Fed is probably going to want to keep its options open to hike more.
The Fed is just well ahead of other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. It is an eventful day before a Fed meeting tomorrow. We'll touch on Halloween here in a moment. Trick or treat, and you see it in Japan. For Global Wall Street this morning, it's simple. Finally, yen moves. The government has not intervened in any way, shape, or form. I got a 161 euro yen, dollar yen 151, and you wonder, it's far, far away, but it's not, Lisa. Japan matters.
Japan was one of the biggest buyers of U.S. securities, in particular corporate credit and U.S. treasuries. If they pull out of the market and can actually get yield, then that's going to make a big difference. And suddenly they can get yield. You get almost 1% now in a Japanese 10-year. It's a market, Tom.
We're looking here at a number of other narratives. Just as we went to air at 6 a.m. on radio, on television, Europe in what I'm calling stag disinflation. Finally, disinflationary trend in place. Thank you, Gilles Moeca, for that. But with it, a surprise, maybe a pan-European contraction like what we've seen in Germany.
We saw a 0.1% contraction in the third quarter. It was expected to be flat. We saw disinflation. This, to me, was the big takeaway from it. Yes, people know that European economies are not doing that great, but the disinflation, consumer prices coming in, increasing at 2.9% versus 3.1%. That's really what moved the market, Tom.
We're going to have to see. Apple, with their announcement last night, Lisa hung on every word. She says, let's go to the store before I go to work at 3 a.m. But other earnings out as well. We got Apple on Thursday, I think. And you're the 3 MacBooks you bought is not going to be in their earnings report this time around. But we've got some surprises here. JetBlue, no surprise. Caterpillar, what do you think?
Well, Caterpillar came out better than expected, and then the shares have come off. So we have to dig through the earnings and to understand what's behind that. With JetBlue, yeah, we understood that they were going to be facing some costs, but the magnitude of those costs and the magnitude of just how much their full year revenue forecasts came in, that came as a surprise. And that's why you see those shares down quite materially.
Maybe it's a weak outlook forward. We'll touch on that and under surveillance this morning as well. We need a brief, and critically, Lisa starts this morning with what matters in America. Strong jobs, but wages, the mystery.
Well, this whole week is really about labor market data in all its nuances. And today, a lot of people are pointing to 8:30 a.m. as one of the key data points, even with the jobs report on Friday, even with initial jobless claims on Thursday. We get U.S. employment cost index for the third quarter, which gives you a sense of full compensation and how much it's increasing, the pace of the increase. It's been increasing at a slower pace, but how much do we need to see this continue to come down to really give people confidence that we can disinflate even without taking the pain?
On radio, it's tough to see the chart, but we do charts on radio. It works. Thank you. Out in Sparta, they want to hear charts on radio. The chart is a disinflationary vector, but it's got a ways to go to get back to where we were pre-pandemic.
Correct. And this is something people are watching closely, especially in light of all the strikes. At 9:30 a.m. on the geopolitical front, we're going to hear from Secretary of State Antony Blinken and Defense Secretary Lloyd Austin. They are testifying in front of the Senate Appropriations Committee. To me, it's going to be really interesting how they try to get the Senate to kind of jawbone the House into some sort of consensus. So far, we've gotten a proposal from the House that is a no-go for the Democrats, and it's a no-go when it comes to the Senate.
I thought Oliver Crook's report in the last hour was brutal from Tel Aviv, and I'm really looking forward to Amory Horton joining us in about 12 minutes here. I mean, AMH on what Washington does about a multi-front war, to me, is the away from the humanitarian agony. The multi-frontness of this is something.
Yeah, and how the U.S. passes $105 billion of new spending at a time where there is growing concern about the deficit and the way of financing it and earnings today.
Right.
We already talked about some of them.
I love to do this. I love to front-run Lisa's brief. She spends hours with her interns putting this together.
Oh, yeah.
And to get out front of earnings and crush you as you talk about JetBlue, Caterpillar, and Pfizer. I mean, why don't you help us here with a further earnings report?
I'm just crushed. I'm just sitting here crying inside, Tom.
You
know, honestly, no, to me, I'm actually very interested. There are 29 companies reporting today. There have been 260 S&P 500 companies that have reported so far about that. So more than halfway through. I'm actually most interested in Pfizer and AMD. So don't worry, you didn't steal my thunder. On one hand, healthcare stocks, a real question about how much they got a boost from the pandemic that's now fading.
So they're back to normal.
Well, are they? Or have they been inflated? Can we go back to Ozempic? And then the question is, with AMD, the chips, is everyone buying a new computer?
Right.
Are some people getting sticker shock when they go to the store and realize that they have to spend that much money on absolutely every single component of a phone that they're buying newly from a store?
From Apple, which
just theoretically.
Was Bramo theoretically here in the last number of hours. You got a personal call from Mr. Paulson at Goldman Sachs on that, using that Apple card.
Yeah, exactly.
Bramo, thank you. It's good of you to do that. Right now, she pulled a short straw. Worst child abuse on Halloween. Emily Rowland of the John Hancock Company made her kids go as Red Sox players for Halloween. This is abuse. They were so bad this year. You know, come on, Emily, you got to do better than that. Maybe go as Bruins. They're doing better than good. Emily Rowland this morning from Boston here on a Halloween. What's your biggest fear out there besides trick-or-treating? What's your biggest fear, Emily, in this market?
My biggest fear is that we're actually in a scary movie right now, but it's not over yet. You know, you think about the villain kind of being wounded but still alive, and the villain is higher borrowing costs in the wake of the Fed raising interest rates in the shortest amount of time and the greatest extent in several decades here. And we really haven't felt the sting from that as far as consumers pulling back, you know, as far as earnings getting hurt by that, profit margins getting crushed. So everything's fine right now. We're sort of running to the safe part of the house as we're getting chased by this villain. But we need to remember that the movie simply isn't over yet.
Oh, my God, Emily, I'm just thinking about you at the sleepover with a bunch of 11-year-olds saying it's a scary house and the Bond villain is coming to get you. At some point, I'm wondering, Emily, how much we're looking at a scenario where yields have kind of reached a peak and that really the uncertainty lies, and I keep harping on this, but it lies with the deficit financing and what we get tomorrow from the Treasury Department. What we got yesterday actually underwhelmed with the amount that the U.S. would have to borrow in the third quarter. And arguably, that's what's leading yields lower this morning.
Yeah, certainly fears around supply have been a key to the narrative around rising bond yields, but it's not like we woke up one morning over the last few weeks and all of a sudden found out that the Treasury was going to have to issue more debt. That's been a known issue. So for us, that's not really the primary reason that bond yields have picked up. It's been just this unrelenting strength in the economic data in the U.S. And certainly fiscal spending has played a role in that. Excess savings have played a role in that in 2020 and 2021. But really, it's been the strength of the data. There's something really, really unusual happening in the bond market right now. One, we're facing down potentially the third consecutive year of negative returns for high quality bonds. That's never happened before in history. We're also looking at an environment where if the Fed was done in July, and we can talk about that, it's really unusual to see the 10-year Treasury yield continuing to rise. Typically what happens is that the 10-year peaks right around the same time or just before the Fed pauses. Very unusual. And then finally, the elusive bear steepener, another very notable dynamic here that is not consistent with what we've seen in recent history. So our view is that we could be getting close here to the peak in yields.
This doesn't sound like a scary story, actually. Arguably, and as Gina Martin-Adams yesterday was saying, this really speaks to a pain trade of more momentum, of gains, of a rally in risk assets, because if yields are rising because of growth, isn't that a good and beautiful thing?
Yeah, I mean, I think our standards for growth have seemed to be shifted a little bit. Yes, there's a lot of strength in the labor market, but we all know that that's lagging data, and those cracks are starting to form. I think this week's going to be really critical in terms of the jobs report on Friday, initial claims, which have stayed stubbornly low. We've got to remember that that data is subject to heavy revisions, and we're seeing a lot of cracks and the consumer story starting to emerge. There's a lot of headwinds out there. The resumption of student loan payments, credit card interest rates at 25% right now, auto loans at 7%, mortgage rates over 8%. That's a challenge.
How do you get out 36 months? You're going to tell me part of a carefully managed portfolio is to look out 3 years, 5 years, 10 years, maybe when the Red Sox go above 500 again. Emily, the basic idea here is people are scared stiff. How much cash at 5x% should they own versus having the courage to reach out 36 months?
Yeah, I think the scary part, I guess, about being in cash right now is that you're subject to significant reinvestment risk. Our view is that the normal relationship with the economic cycle and bond yields remarries as we head into this economic contraction into next year. And in that environment, you want to move out the curve and just really be able to capture the 5-6% income that you're seeing in high quality bonds right now. I know we've been talking about this for a while. There's been these significant odd dislocations in the bond market, but if you're in cash right now, you might not get that yield next year. We have an opportunity to lock that income stream in for years, and I think we're going to look back on this as quite an incredible opportunity to unlock the value in bonds.
Thank you. Emily Rowland, John Hancock Investment Management, Boston, this morning. Lisa, the dynamics in the market across equities, bonds, currencies, commodities are tangible here into the Fed meeting tomorrow. I mean, in 7 basis points in the 10-year yield within the weekly volatility. Maybe it's collared, it's banded, but still there's movements in bonds. And I'm watching the relentless move of yen, intraday dollar yen. We can show this on TV. It's a great intraday chart on radio as well. And the answer is up we go. And it just, I mean, I'm sorry, there's no bid on yen. There's nobody looking for a 149 yen this morning.
Even though there was a bit of relaxation in yield curve control, all things being equal, that could restrain inflation and actually allow the currency to normalize. On the flip side, everyone was expecting this, and that's what Mark McCormick said. And people were actually expecting that much more with respect to a guidance about possibly taking greater actions from the Bank of Japan.
You know, we'll see what they do overnight into 7 a.m. I think Ferro's going to be watching that. I don't know where he is right now, but maybe it's better time zone for him. We'll see that tonight, 7 p.m. Look to Asia, Bloomberg Radio and Bloomberg Television. But Lisa, to me, and Gilles Moet colored this, I mean, I don't think at the Lagarde press conference X number of days ago, we really thought about euro disinflation. There it is.
And that's going to be good news for the ECB. But we heard from Gilles Moet, and this I think is one of the salient points. Europe is taking pain as a result. The U.S., not as much.
Is it a live meeting tomorrow? It's a live meeting?
I mean, market's basically saying no.
We'll have to see. The Standard & Poor's 500 up 0.3%.
I say I don't think it is going to be a live meeting, Tom, just simply because the market right now is basically expecting them to stand pat. And there's no reason for them to move unless there is some massive surprise in the data coming up to that. I don't know, though, what that is. Are they still data dependent, or are they being driven a little bit more by a wait and see mentality with this belief still imbued that we are going to see the disinflation that we just saw over in Europe?
November 1. December, I think it's 13th or 15th, can't remember. January 31st of next year. 2 meetings out seems like a year away. How does anyone model a guesstimate of disinflation for January 31st?
I don't know how anyone can model disinflation for the next year, or at least the next month. There is a real question, though, about whether the long end of the yield curve is doing the Fed's work for it. And I was looking at the Bloomberg Financial Conditions Index, and it has contracted somewhat material to a tighter kind of level. You are seeing it more meaningfully as credit spreads widen and as long-term bond yields rise. How does this feed into equities that have kind of been resilient? How does this feed into the global story? This is a confusing brew. That's all I can say.
Confusing brew.
Yeah, next year I'll do that for Halloween.
Thanksgiving and Halloween is, well, I mean, you know, we make a joke about it, but the toxic brew, is it a toxic brew with a VIX of 19.30? I'm sorry, that's not.
Does the VIX
we
still work?
shouldn't be in a panic or crisis if I look at the equity market. Period.
I think that that's a fair assessment. I think equities are not expressing panic, although it depends where. Take a look at some of the regional banks.
Regional banks. We'll talk about small cap as well. Lori Calvasina was warbling gaily about that yesterday. Coming up, his optimism on the market. John Stolfus, OPCO. Good morning.
The only thing that I intend to have resign is Hamas. We're going to resign them to the dustbin of history. That's my goal, that's my responsibility, and that's what I'm leading the country to do.
The Prime Minister of Israel, Benjamin Netanyahu, there from Tel Aviv. He's been very active in the past 24 hours. We say good morning to all of you. Bloomberg Surveillance on radio, on television, on YouTube as well. Futures advance up 11, a better tape. Focusing now really on what we see in the currency market. Lots of action in Euro and Japanese dynamics. The yield, the 10-year yield in 7 basis points, back and forth and back and forth.
Good way of framing
on the yield. Lisa, to set this up, I am benumbed by pictures of Gaza. I'm speaking as a complete hack and amateur that look like Aleppo, that look like Syria, from a complete devastation. There's no other way to put it.
I would agree with that. Yeah. Just entire neighborhoods taken out, flattened. And there's a real question about when this is going to end, how far this will go, and what it would take to really end this, especially after hearing Netanyahu saying a ceasefire is not in the picture. Bloomberg's Oliver Crook in Tel Aviv, Emery Herdern in Washington. Both of you joining us now, thank you. Oliver, I want to start with you. What does winning look like for Israel as they go deeper into Gaza?
I think that's a very good question. I mean, if we think about the figures that we've heard about how many Hamas operatives there are, 30,000, potentially, how many of them are they going to be able to get? And how do you really, how do you dismantle something that is really an ideology? And I think this is a question for many people, particularly as this ground invasion continues to get underway. And again, with all of the mounting pressures externally, I mean, we heard from Benjamin Netanyahu last night, really on the defensive, both as a defense of the Israeli nation and its actions in Gaza, where more than 8,000 are dead now, according to the authorities there, but also defensive personally. As alluded to in that soundbite that we heard from him, he was asked by a journalist, you're losing public support within Israel. Can you continue to lead? He says that the only thing he wants to resign is Hamas. But again, this is part of the equation for Benjamin Netanyahu, a prime minister under fire.
There's a question, Anne-Marie, about how regional players are really arranging. And we saw yesterday a Saudi Arabia representative coming to meet with U.S. officials to talk through some of these issues, among others. Do we have any sense of how some of the players with leverage who are able to negotiate are stepping in or trying to maneuver?
Well, I think what you can see and what's very apparent is that most players want to avoid a regional conflict. They want to avoid what is going on between Israel and Hamas from spreading, which is why Khalid bin Salman, the Crown Prince's brother and the Saudi defense minister, was here in the capital yesterday. It also came at a moment of heightened importance for Riyadh, given the fact that on their southern border, they have been dealing, and they did recently deal over the weekend, with Houthis and missiles coming over from the Houthis, which are backed by Iran as well, the same way Hamas and Lebanese Hezbollah are backed by Iran. And what makes this incident more nerve-wracking for the Saudis as opposed to previous incidents. I mean, I've been in Saudi Arabia myself when Houthi missiles have come over. This is not something new. Before Saudis died in this incident. So you can see there's still frenetic diplomacy throughout the region. Tremendous amount of phone calls happened over the weekend, and now visits, because most of these players, especially in the Arab world, want to avoid a regional conflict.
Ollie, we keep thinking about the hostages, and the number keeps going up. We never really know exactly how many, and currently the number, I believe, stands at something like 240, as there is more clarity. And one person who was brought back to Israel yesterday. What do we know about how that's complicating things, not just with logistics, but also on a political level with the families of some of these hostages?
Well, we mentioned a number of the pressures that Benjamin Netanyahu faces. One that we didn't mention, which is very real, is that basically can this military campaign, and particularly the ground invasion segment of it, does that jeopardize the safety and of these hostages that are being held by Hamas? Again, which a number which continues to change. And again, as you say, 240 is the number we got today after there was one, we understand, that was recaptured or somehow dislodged in Gaza over the weekend. But again, this is one of the many, many issues that they're dealing with. And one note that we need to make every now and then is we do not actually know how many of those 240 are actually still alive and how many are the bodies that are just being held by Hamas at the moment.
Emory Harden, in the debate, is the voice of Robert Gates. All can agree he's an important voice with a legacy and institutional memory of his America, the former defense secretary, the former head of CIA. His article in Foreign Affairs magazine, Anne-Marie, is my read of the autumn. There's no question about it. It's an incredible, intense essay of the dysfunctional superpower, the dysfunctional beltway. Is there a middle ground in Washington that wants to get things done?
There is. When you look at the center of both parties, they definitely want to move forward. But when you talk about some of this paralysis we're seeing in Washington, you're going to see it in the next few weeks when it comes to aiding Israel. Right now, what you're going to see this week on Thursday is Mike Johnson, the new speaker, put on the floor aid to Israel. But to balance that, he's going to rescind billions of dollars that happened under the Inflation Reduction Act that goes to the IRS. What you are hearing from Senate Democrats is that this is dead on arrival. That's what Senator Patty Murray had to say, and she's the chair of the Senate Appropriations Committee. Ben Cardin says it's a poison bill. But more importantly, Tom, Senate Minority Leader Mitch McConnell yesterday was in Louisville at the university there, standing next to Oksana Markarova, the Ukrainian ambassador to the United States. And he has been staunch, forthright, emphatic about the fact that it cannot just be aid to Israel. It must be aid to Israel, Ukraine, Taiwan, as well as the southern border. So you're going to see a massive amount of Republican infighting over the course of the next few weeks.
The heart of the Gates essay, Emory Horton, is that the politicians have to educate America. Does America want to be educated by those looking for an international Washington, or is it a new isolationism?
I think it depends who you ask. What polls have showed since Putin's invasion of Ukraine is that while Americans did at first support Ukraine, there have been more concerns about how long this conflict is going to last and about how much money, U.S. taxpayer money, is being sent to Ukraine without an end goal or an end vision for this conflict. So the longer these conflicts drag on, the harder it is for politicians to sell them back home, because the number one priority for Americans right now, if you look at every single poll, is the economy. And when it comes to the economy, it's their concerns with inflation.
Oliver Crook, we are in tonight in the Eastern Mediterranean when things happen. What should we look for in the Israeli and the Levant evening?
Well, what's been interesting is ever since I came back on Sunday, there has been not a single air raid siren in Tel Aviv and in central Israel that I have heard, which was a regular occurrence 2 to 3 times a day. Again, this may be speaking to some of the depletions of the resources that Hamas has in terms of the longer range missiles. But again, what we're watching, Tom, is the same thing as ever, is that fear of escalation. But what does that actually mean? And in the form of Hezbollah, this is the 150,000 rockets that sit on the southern border of Lebanon. And this is really the trigger point that we watch here in Israel for a meaningful escalation.
Oliver Crook, thank you, from Tel Aviv, and Emory Horton in Washington this morning. Lisa, the multi-front of this, just in the time I took off here, there's been a radical shift in 4 days.
There's been a radical shift in terms of the expansion on some levels, but also the humanitarian crisis in Gaza. Also, this question around where the balance of support is in the United States, given some of the internecine battles over exactly how you deliver aid. It is such a difficult moment to parse that is incredibly polarizing around the world.
Balance of power tonight will continue to drive this forward. Sandan on Bloomberg Radio as well. A data check shows an advancing equity market off the joy of yesterday. Futures up 13. I'm at a 4,200 level on SPX, 33,000 on the Dow, 14,400 on the NASDAQ 100, up 0.2%. Dow leading the charge this morning. We've seen that in the last couple days. VIX from a 22 into 19.24 shows normalizing equities, a 10-year yield 4.82%, and the 10-year real yield is quiescent here, 2.39%. What I see, Lisa, is the amazing restrictive nature of the Bloomberg Financial Conditions Index. Will they cut rates tomorrow?
Yeah, they're not going to cut rates anytime in the near future. And there's really a question of whether this has moved away from the Fed's purview.
Purview. We're going to have purview tomorrow. The Fed decides. This is going to be important. Richard Clarida scheduled to join us as well. Brent crude, have not mentioned it this morning, $88 the barrel. Sonia Martin, next. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on assignment, as they say. On this Halloween, the Queen of Halloween is with us. She's going as Toxic Brew. I'm going as Yield Curve Control. We'll cover that here in a moment. Sonia Martin is scheduled to join us right now on the data front, and it is an eventful FX data today with the dollar flat, but significant, and I'm going to say historic moves in yen out to a $151 yen and a 161 euro yen as well, and the wait is on for some form of intervention, which I'm going to be honest can come in a set of flavors as well. It's not as cookie cutter is saying there'll be intervention. Sterling 121.85, euro 106.59 off some stunning European data. Brent crude 88 is a global price. West Texas down under $83 a barrel. And in the equity market, futures up 13. We need to look at movers. I'm going to suggest Friday, Apple will be a mover off Thursday evening earnings. Right now, JetBlue this morning, a mover. Caterpillar, a mover. And they are very outlooky in that even Caterpillar lifted on the headlines and then reversed on the outlook. People, Lisa, looking forward.
Yeah, it's
on movers and not liking what they see.
Yeah, it's order backlog falling, and that seems to be driving some of the action. It seems like the forward look is more important than anything else. JetBlue's forward look revised downward, which possibly is causing the significant sell-off. That said, outside of just the stock move, what I thought was interesting about Caterpillar, listen to this line. Caterpillar cites favorable price realization and higher sales volume. Basically, they're jacking up prices and still selling more.
So that's what McDonald's did yesterday.
Exactly.
We're taking the I have a Caterpillar Zamboni. It's really great.
We've heard about it.
It's great. Yeah, it's really good. But whether you got a Caterpillar lawnmower or a bulldozer, why is it any different than a number 2 value meal at McDonald's? I don't think it is.
There might be some differences between a number 2 value meal and Caterpillar equipment. Nonetheless, we'll save that for later in the hour. Under surveillance right now, pressure growing for Israeli Prime Minister Benjamin Netanyahu to resign. Rivals have accused Netanyahu of refusing to accept responsibility for security lapses leading up to the October 7th attacks by Hamas. In a news conference yesterday, Netanyahu vowed to fight Hamas until, quote, the battle is won, and said calls for a ceasefire are, quote, calls for Israel to surrender. We've been covering this throughout the morning. I don't want to get into the conflict as much as how this is being read through to markets, Tom. This question of, are we seeing escalation? Well, yes, we are seeing escalation. There's fighting in new places. But is this something that's going to continue to cast a pall, a sort of depression over the whole world on an emotional and humanitarian way? Of course. On a markets level, TBD.
TBD. That's Bramo talk. That's like jargon for the street. TBD is pretty important here, and I guess you've got to look at the currency, but far more than that, I look global oil price, $88 a barrel, suggests to me that round trip off the Anks, and that could change suddenly, and it even could change here into the Israeli evening.
Although we are seeing a bit of a lift over the past couple of weeks to gold, so that's one area to watch. The Bank of Japan, meanwhile, loosening its grip on so-called yield curve control, Tom's favorite Halloween costume. It remains the last global central bank to hang on to a negative interest rate, though, so they have a long way to go. After the bank's decision to hold rates, it announced it would allow more flexibility for the 10-year JGB, saying 1% is now just a reference point, and sure enough, yields climbed right toward that level.
Mark McCormick nailed this earlier this morning, that we think about export like the emotion for America is Toyota's being exported. That's from another time and place. It's about the imports they have to bring in with an ever weaker yen, a 40% depreciation over the last 11 years. Maybe it's been grinding, but could you imagine this discussion in America with a 40% depreciation of US dollar?
There's good inflation and there's bad inflation. There's also inflation that you just have to deal with, and you can't just ignore. You can't have Operation Ostrich, as John calls it. And at this point, are we seeing that realization, or are they not doing enough? It seems like the currency market is saying, we're unimpressed. Meanwhile, this story I know you've been following. Wells Fargo analyst Mike Mayo, always renegade, raising questions about bonuses given to candidates in the race at Morgan Stanley to replace CEO James Gorman. Morgan Stanley is awarding $20 million bonuses to incoming CEO Ted Pick, as well as runners-up Andy Saperstein and Dan Simkowitz. In a note to clients, Mayo writing that the succession plan is, quote, more reliant on comp than realized, and that, quote, paying top executives to stay raises a question about whether they are staying more due to compensation than culture.
I get this, and we're going to talk to Sonali Basak about this, folks, but, my basic take here on this is that's why they're there, comp. I mean, every bank could go, we're going to cut costs, but our top 15% people, we got to keep them this week. And I believe these two characters are, I mean, Gorman really went after me the other day. I mean, I'm like, should these guys stay? Should these guys go? And the executive chairman was all bent out of shape. And the bottom line is, I'm not saying they should stay or should they go, but they're not going to stay without compensation.
Unless they believe in the vision and the idea of this question of Dan Simkowitz and Andy Saperstein, Andy Saperstein in particular, being stiffed for the CEO job. I'm not saying that that's how it was borne out in the bank, but that was sort of one of the perceptions out there. They're basically bribing him. Stick around for a little longer. That's
totally
one theory.
Disagree.
And I don't think you could agree.
Totally
I mean, honestly, I think a lot of people would agree with that. But Mike Mayo raising this question about governance.
We'll talk about this, Sonali Basak, as we look at the vision of an American at Wall Street. Right now, the vision in foreign exchange. Sonia Martin joins us, foreign exchange and monetary policy head at DZ Bank. Sonia, what's your best trade in this turmoil? What is the to-do for Sonia Martin?
Well, good question. I think actually right now the dollar is interesting in the sense that we have seen some weakening of the dollar of late, and it's not just been against the euro. We have seen euro dollar rise again, just today is in particular. And I think that's not just because we've had some data out of Europe, which has been interesting, but I actually think the reaction of the market to the US data last week is an important signal. We had a really strong Q3 GDP reading, and yet the dollar failed to benefit. And, that's always a sign, I think, that, the market is priced in all of the good news and that we are maybe now primed for downside disappointment. So I think dollar weakness is something that we'll be looking at the next few months.
What should we watch is the distinctive tea leaf that will signal dollar weakness?
It's got to have to be a clear sign that all those pressure points that are working on the U.S. economy, and I think you mentioned them earlier on the show, interest rates are rising, mortgage rates, credit card debt is rising, credit card rates are rising. All of that is weighing on consumption. And so far, the U.S. consumer has been incredibly resilient, I suspect because of the strong labor market. But that's going to change. So I think that's where we need to look at. We need to look at signs that consumption is declining and that consumer confidence is declining. And I think that's going to be the signal people finally start to price in a somewhat weaker outlook for the U.S.
Well, that's exactly where I wanted to go. Gilles Moek earlier was saying that you can see Europe is taking the pain to get the disinflation that we saw today. It's not clear that the U.S. is. We just saw a massive acceleration in GDP, the biggest in almost 2 years. Is that enough? In the U.S., enough pain, or lack thereof, to continue with this disinflation?
Well, that's the problem for the Fed, isn't it? I mean, no one's expecting the Fed to hike rates this week. That's clear. There's some speculation about December. But that's the problem for the Fed, isn't it? The economy, the real fundamentals are still surprisingly solid. Inflation has come down, but is it going to continue to decline? If growth in the U.S. does not show signs of weakness soon, then that's going to become a problem because then the Fed might find itself facing inflation that has come off the highs but will remain too high. And this will be the trigger for potential one more rate hike before the year ends.
Sonia, you mentioned that no one is expecting the Fed to hike rates tomorrow, and that I think is a pretty accurate assessment right now. At the same time, if they're truly data dependent, how high is the bar really to hike at this point, right? Because the data has come in pretty strong. In other words, could we see something this week that could make you change your impression that they will have to do more later on?
Well, I think the best way to move forward with the Fed tomorrow is to actually remain relatively hawkish in its wording, because they need to keep an eye on inflation expectations. And this is a big issue, isn't it? If you look at underlying inflation has come off, but it's still too high. We have so far not seen a lasting massive impact on the oil price from the situation at least, but that could change. And we have a really strong labor market still. So all of that suggests to me that there's still quite a bit of underlying inflation pressure in the economy. And that's what they keep an eye out for. And so the labor market report this week will be important, of course. And I think they're clever if they're going to keep the door open, just to make sure.
Sonia, what will you listen for tomorrow from Jerome Powell?
I think the key point is how he assesses the latest strength in the U.S. economy. Like, will he give any indication as to whether the Fed believes that there is real downside risk from here? And of course, will he signal that the Fed may still have to do more if that's necessary? The emphasis on, there might still be more to come. I think that's going to be the key. Not so much, I have to say, for the financial market, in the sense that I think even if the Fed were to hike one more time, that's not going to make a huge difference in terms of yields of the dollar. But I think, as far as the Fed outlook is concerned, that's the key.
Sonia, thank you so much for the brief. Sonia Martin of DZ Bank in Frankfurt, Germany, this morning. We draw your attention to our Fed show tomorrow. Always a good lineup of guests. One of our guests will be Jerome Powell. He's the chairman of the Federal Reserve System. It's a 1:30 start for us, and it's going to be really interesting to engage the conversation scheduled. The former vice chairman of the Federal Reserve System from Columbia, Richard Clarida, I did a panel with him the other day, and what was so great about it, there was no policy urgency to it. We just wandered through almost the academic confusion that a heavyweight like Clarida has.
And that confusion leads to a question about whether the Fed is actually going to have to do more than people expect because of the strength that we're seeing in the U.S. economy, which is the reason why part of the debate right now underpinning the Fed is how much is really Fed policy, how much are yields being driven by inflation, as well as what we're seeing in the economic growth, and how much is it just supply and demand? And we're going to see that, too, tomorrow, the refunding agreement, the refunding announcement from the Treasury Department.
What was so great about Richard Clarida was he talked about the mathiness. We do calculus on Halloween, folks. Stay with us here. I'm going as Leibniz
it's scary.
Next year. Or maybe I'll go as Newton. It's more accessible. But the bottom line is we're going to do some calculus because Clarida did. And he said what surprised him on his tour of duty was the partial derivatives, the taking big things and looking at their smaller dynamics, and the many partial derivatives he was not aware were there within the day-to-day policy making that was out there.
It has been a fascinating time with microeconomies coming together to make up this larger picture of economic momentum and inflation, parsing those out and then understanding how the Fed policy pours into that. It's a confusing brew.
Okay, that was our calculus for the day. Ferro's going to email in and say enough of that. Futures up 11, S&P 500 up 0.3%.
We're also being colored by earnings. And yesterday, Gina Martin Adams kept yelling at me, come on, focus on Apple. It's all about margins. It's all about Apple. This is about 7% of the S&P 500. It's a major thing that's going to be coming out on Thursday. How much is this earnings taking center stage or not? I have been actually surprised at how much there's been sort of a negative damper and punishment of stocks more than anything else. Ben Laidler nailed this morning where he said 80% of 80% of earnings are in, 80% of stocks that have reported so far, they've beaten earnings, and yet it's like, yeah. I mean, that's what Laidler said. He said it just really hasn't happened. It's the forward look, and outside of big tech, you've seen a lot of pain. And yesterday, Lori Calvasina was saying it's
What did
unclear.
she say? I missed this. This is important.
What you're seeing is the Russell 2000 reach levels that we have not seen since November of 2020. That was before we had a vaccine. That was before we really reemerged from lockdowns. she's saying that the actual economics don't really justify that actually these companies are not doing that badly, that they're actually coming around a bit. But people still have a dramatic aversion to this risk. So the question is, do you go with sentiment or do you go with something more fundamental? And it's kind of driving people bonkers because you have something where you can make a really good argument, but it's going to be wrong in market practice.
I mean, I'm looking at the bank index right now. I took a couple days off, folks. I've lost track. Come on, BKX, right in the bottom of 2023, not quite back to where we were in 2020.
It's the same kind of story. Basically, there is pain out there. It's just sort of masked by the behemoths that are sucking up our cash for children to have devices so that they can go around and be with their friends and walkie-talkies.
We've been having fun today. Kids, be careful out there tonight. Bloomberg surveillance.
I think we see the UAW contract tentative agreement with GM, Ford, and Stellantis as being a very positive outcome of what can happen when the parties really work in good faith and stay at the collective bargaining table. What we are seeing is good faith negotiations leading to workers getting a fair share of the gains in these industries at a time when American companies are really doing so well.
Lau Brainerd, the National Economic Council Director, managing the message from the White House. I'm going to suggest they got to be happy. Good morning, Bloomberg Surveillance, Lisa Abramowicz and Tom Keene. John Ferro, it's sort of like, when they get ready for the balloons at Thanksgiving, where the night before they lift the balloons on Central Park West.
They blow them up, yeah.
I went over once and watched it. It's very, very cool how they do that. I went over when you could get close to the balloons.
Yeah, before they cordoned it off, and then the crowds were kind of sectioned off.
Ferro is so all in Halloween.
Oh, yeah.
That he's takes, that's why he's been on a cruise and he came back. He says, I can't come in. I'm in preparation for his costume or whatever.
So we're going to expect some significant costume pictures tomorrow when
he's going returns. As Adele.
Adele, yeah. He's got lots of ideas for that. I will say, when you talk about the auto manufacturers and what happened yesterday, it does seem like a 7-week strike is largely over, and you're seeing a relief rally in some shares. Stellantis shares up, for example. ADR is going up about 3.3% this morning, even though they came out, reported earnings, and said that they saw net revenue hit of about 3 billion euros from the work stoppages. So there are some feelings that there was some, loss, but not enough to really torpedo anything.
We walked away from the story, but Lisa, very quickly here before we go to Gabriella Coppola, to me, what's disappeared is a debate on EV. I mean, the basic news flow on EV over the last 3, 4, 5 weeks has been, okay, everybody that wants one's bought one, now what? And that's sort of an undercurrent here, let's get back to work and make gasoline and diesel engines.
There are a lot of questions here. Yeah. And I think their first question is just on a union perspective, have workers gotten their fair share during the recovery as auto prices climbed record levels? The second thing is, how do U.S. companies remain competitive with an emphasis on electric vehicle production when consumers don't all want them because they're outpriced or they're outranked? So there are these questions, these competing goals, and then is it wage or is it the other compensation, like benefits, like pensions, some of the other things?
We haven't covered this story with all the distractions. Gabriella Coppola doesn't have that luxury. Out of Southfield, Dearborn, and Detroit, she is up to speed on a big American strike. Gabriella, let's start there right now. How big is this strike?
Well, this was a historic strike. It has never happened that they struck all 3 companies at once. And it was a very different strategy than, in the past, they would just take one, like in 2019 when GM, they just went, one automaker and took out all their plants. But this was, almost, about 47,000 people were on strike in total, if you add up all the different plants that were struck.
Do you feel that it's over? I mean, if I got a Bloomberg headline, GM reaches tentative deal with UAW, I guess it's Ford, it's Chrysler, and now GM. Is the strike over this morning?
Well, I think the leadership of the UAW and then the workers have to vote to ratify the agreement. So it's technically not over, but people are going back to work. And I think from early reactions of, say, from some of the workers at Ford who've seen the deal, people are really overjoyed. I think people can't believe what an incredible deal they got. There's really not I think, they didn't get defined benefit pensions back, or, I'm not saying it was perfect. And there's some people who still lost a lot, maybe in 2007, 2009, they want everything back. That's still going to be disappointing. But overall, I think it's a pretty, it's just an incredible deal for people. It's way, way better than what they got in 2019.
Gabrielle, there's
a
question about how much the UAW has gotten support outside of the union, right? Union membership doesn't really represent the bulk of electric vehicle production workers, particularly not in Tesla and certainly not at other manufacturers outside of the Detroit Big Three in the U.S. How much did this actually give the UAW clout in negotiating for a broader swath of employees?
I think it gives them the best shot they've had in a very long time, maybe ever. That doesn't mean they're going to be successful, but they do have, I think the union was negotiating with that goal in mind. We broke stories that talked about there was a magic number. They wanted to be able to show at least a 30% wage increase, which they basically got if you add the 25% plus the inflation adjustment that they won. That was something they wanted to be able to bring to other car companies. And especially at the bottom rung, because, the big issue with the UAW workers has always been that ever since the financial crisis, there were two tiers and there were temp workers. So, those great middle class jobs that are kind of the stuff of, political speeches and things like that. Only part of the workforce had that. Other people, like if you're a temp worker, I met people on the picket line that, had started at $15.67 an hour, and they've been in that temporary status for years.
Yeah.
Not getting profit sharing, not getting 401k, not getting the benefits of a full-time worker. This deal brings all those people up, and I think that is going to be more attractive to, temps at, say, a Toyota or a Volkswagen or a Tesla or, whatever.
What about from the U.S. auto manufacturers' competitiveness standpoint? There is a concern of how U.S. automakers are going to compete with China, for example, when it comes to electric vehicles. How concerned are people that that's been set back as a result of some of these agreements?
I have to say, I personally am very concerned about that, just from my knowledge as a reporter, and just looking at the world and the people that I talk to, whether they be in finance or, auto executives, things like that. I have to say, it seems like the reaction on Wall Street, maybe people are just so relieved that this is over.
Yeah.
And they knew that they were going to have to pay up, right? I keep reminding people that over the past 4 years, these people didn't get any raises, or only what was contractually negotiated in their previous contract. So while inflation was popping, they were not getting those gains. So they knew, I think people knew they're going to have to pay up. But I think they're just relieved that it's over. But I think the competitors' concern, that I think the companies are talking about how they're going to offset these new labor costs in other ways, which is fine. But I wouldn't put too much of the onus on the UAW. People often want to just blame, labor for all the automakers' problems, and I don't think that's at all fair. Certainly this makes it harder, but the tougher thing is, how do you go from making combustion vehicles at a very nice profit to scaling up electric vehicle production when you don't have experience doing it? You're working out all the kinks, and demand is softening because interest rates are so high.
Okay. Well, Gabrielle, let's get out in front of this. Let me rip up the script here. Are EVs dead? With the news flow of the last 2, 3, 4 weeks, away from the strike, as we go into 2024, are we going to see a massive adjustment in the American EV market?
I think, I wouldn't say dead. I think that the growth, they're still growing. It's that the growth is slowing. And I think you're seeing the car makers pivot to hybrids more because they've got to meet those stricter, emissions rules. I think gas is not that cheap. Gas is still pretty expensive. So, hybrids are very popular. They're doing very well right now. But there's no way that EVs are dead. I still feel like long term, this is the future. I was talking about this with somebody yesterday. There's a lot of people that advocate, well, why doesn't the U.S. just stay on gas cars and kind of build our own little hermit kingdom over here and stick our heads in the sand? Just, don't do EVs because people don't want them. And you can't do that because every day that you wait on that, another day that, China gets better at it and you're behind.
Gabrielle, I just got to say, you're an absolute trooper. You were at the Lions-Raiders game last night at Ford Field, And here she is on Bloomberg this morning. Gabrielle Coppola.
It was a great night. It was a great night for the Lions.
It was a great night for the Lions. Thank you for our Detroit Lions update, Gabrielle Coppola, as well. I watched a few minutes for Michael Barr.
I was just going to say, you're just basically doing a hat tip to Michael Barr.
They're 6-2. I mean, this is beneath the radar. Max Verstappen's winning in Formula One. The Tots are in first place Premier League football. It's completely drowned out by a 6-2 Detroit Lions into Thanksgiving football. Yeah. I can just see Thanksgiving football at the Brammo House. TV goes on at 11 a.m.
And just all day long.
3 games.
Very much
ending
so.
with the Cowboys.
The Brammo family more likely be out in the park playing football and tackling each other.
Oh, here we go, playing Frisbee or something.
With Berks on. Not quite.
Yeah. I played Frisbee.
Ultimate Frisbee.
I had a bottle of cold duck and played Frisbee when I was 17, and they said, "That's okay, Tom. Go skate."
I'm pretty bad at Frisbee. I've got to be honest.
Yeah. Ferro, you should see Ferro.
Oh, yeah, he's an ace. He's the ace at Ultimate Frisbee.
Scary. It's scary.
I can see that.
John Stolfus, you need to be in the market. Good morning.
The problem is that the market is losing confidence in any one narrative.
The fiscal support at both the federal and state level, I think, is reducing the odds of a recession.
The Federal Reserve needs to target growth that's under potential.
We think that the Fed is getting very close to being finished at this point.
We have to start having some very deep conversations about whether the inflation and the interest rate relationship will be stable over time. My sense is it's going to disconnect somewhat.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It's about the American paycheck. From New York, good morning. Welcome back. This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, Lisa Abramowicz. John is off exploring the Apple Store ahead of earnings on Thursday. And honestly, Tom, to me, we haven't talked enough about this. 30 minutes time, we get employment cost index at a time where wages very much in focus.
The jobs report after a Fed meeting, and the basic idea here is what does it mean for wages, not only salaries, wages, but also benefits. Of all the different indicators, ECI is the thing I look at the most. Not 60,000 feet, but 25,000 feet coming into Newark. You make you turn at Paterson, New Jersey, about that level. And what I'm looking at here is what is the labor economy doing? We're going to get a lot of information on that.
And this, to me, is sort of the big question mark. How does it matter at a time where the data, essentially the Fed is saying they're data dependent, but everyone has written off whether or not this is a live meeting and what it's going to take for them to raise rates further if more employment might be a good thing if we also get disinflation.
And also if we get disinflation. To me, that's the hard is melding the two themes of our Fed meeting, our coverage tomorrow with Richard Clarida. And the basic idea here is that disinflationary vectors in place if you look at what we saw from the European Union this morning.
Right, although we also saw the weakness in the European Union with a contraction there. At the same time,
so what are you going to do? Raise rates? You're going to stay as restrictive there, or the contraction and literally borderline European austerity? Does that work?
There's a big question about whether you need some sort of economic, I don't even want to say contraction, but pain, weakness in order to drive disinflation, or whether you could get both. And a lot of it hinges on productivity. We're going to be getting some data out on that front as well. At the same time, we're looking at the economic data of companies, and what we see time and again is they're able to raise prices and increase volumes. We saw this with McDonald's, and we saw this today with Caterpillar. So how much can you put together a Big Mac and a Caterpillar backhoe? I don't know, but there is some sort of rhyming here outside of certain sectors like the airlines where you're seeing that kind of strength.
Okay, that's there, but the pricing power into a resilient American economy has been the shock of 2023. I want to get out ahead and say what's the shock of 2024, and it's sobering to look at Caterpillar today, up. And then they pull it in as well. That's the outlook that maybe we need to adjust to.
Was the outlook so bad, or was it just that people are looking for weakness? Yesterday, what we heard from certainly Gina Martin-Adams was she thinks the biggest pain trade is actually a rally, is actually that suddenly something is going to happen.
Totally.
That's going to lead people there.
Well, futures up 10. I mean, leave the data check here, Lisa. The answer is futures up 10. I got a VIX back in under 20. No one's looking for VIX 16, VIX 15. I mean, no one is looking for what Gina Martin Adams is talking about.
Well, stocks have not been very volatile relative to bonds, and I think that has been sort of one of the big conundrums. Who's right here with stocks kind of looking forward and bonds, I don't know, kind of bouncing around. Just the idea that you get an 8 basis point drop in a 10-year, and that's not leading our coverage, 4.81%. We're just sort of thinking, okay, it's more volatility.
It's more volatility, exactly, precisely. More volatility within the market. I'm going to look at Brent crude, $88 a barrel. What's so great about our guest? I mean, I'm going as yield curve control. You're going as a toxic brew. George Bunker and Simon Ramo, before Mike Bloomberg, we had Bunker Ramos. And the Bloomberg, true story, folks, the Bloomberg shows up. There's a guy that kicked footballs years ago named Charles Gogolak. He goes, Tom, there's this new machine. And I'm looking at Mike Bloomberg and Tom Secunda's machine, and I'm going, God, it's gorgeous compared to a Bunker Ramo. John Stolfus is going as Bunker Ramo tonight, one of the old machines.
I don't even know what a Bunker Ramo is.
It's like before Bloomberg, you had a Bunker Ramo, and it was lousy compared to what you could do with bonds on the Bloomberg.
Well, John Stolfus also has been looking at S&P targets in addition to the Bunker Ramo, and he actually had previously expanded his target earlier, 4,900 at one point. Then the S&P entered a technical correction, and John Stolfus of Oppenheimer lowered his year-end forecast for the S&P back to 4,400, kind of where it was earlier this year from that 4,900 mark previously. John Stolfus has been listening to this and wants to weigh in on the Bunker Ramo and beyond, and I'll let you get to that. But first, I want to start to say, how much are you basically saying we've just have run out of time to get to that 4,900 mark?
Yeah, it really is. We had to right size our expectations. We always suggest that to investors as they consider what happens when markets are roiled, so to speak. And what we've got to consider here is the calendar is telling us that we're getting close to a year end. The average rallies are positive. You know, we get positive rallies after a dip like we've seen traditionally or historically, but it's smaller amounts, and there's still lots of uncertainty that bears and nervous investors and those who are skeptics can use to take more profits out of the fabulous rally that we're still living off from the lows of October 12th of last year.
I feel like one strategist after another is basically coming on and saying, give investors a Prozac, because frankly, there is a lot of optimism. They're just not seeing it. How much can you really hinge on fundamentals if the sentiment is just so gloomy and prepared for the worst?
The real problem is, I think that when you're in a Fed funds hike cycle, it takes a while before the marketplace gets a sense that the Fed is indeed not trying to destroy things, and that the Fed might actually succeed in its goals. The Fed isn't infallible, but the Fed has a remarkably simple a mandate, essentially, stable economic growth with maximum employment. Of course, what is it? A few weeks ago, I think it was the daily quote on the Bloomberg was Martin Scorsese, and it was something that like simple is the best, but it's the hardest to achieve. Well, that's what happens in a Fed funds hike cycle. But what happens is eventually the marketplace, and you can see it related to higher prices being accepted by consumers and business in that you were just mentioning before. There's a sense, okay, we can deal with this now, and we keep moving forward. The Fed has been so sensitive in applying its mandate that it hasn't knocked apart the resilience in the consumer, in business, and the overall economy. It's been extraordinary.
John, Michael McKee out with a brilliant idea on the Magnificent Seven. He's going back to the movies, looking at Yul Brynner, Steve McQueen, Charles Bronson, Robert Vaughn, James Coburn, Horst Buchholz, and Brad Dexter. I mean, they were the Magnificent Seven. What do you do with a modern Magnificent Seven? Is Apple going to deliver here? And if you're going gloomy 4,400, do you sell your big tech?
Well, I'm not gloomy of 400 at all. I'm just saying it's more realistic from here to the end of the year. Just wait until we put in our price target for next year.
Go ahead.
That'll be later on.
Well, good. And no one's watching here.
Yeah,
come on, compliance at OPCO's not watching. Give me a number. Can you pop a 5,000 for next year?
Can't do it. I got compliance breathing down my back. But when we look at this, things are getting better, and we think we're going to see competition return in a lot of spaces. And competition is when all of a sudden you've got everybody is passing on the old higher prices, getting away with it, and then some guy in business or gal discovers the idea of, well, maybe if I give up a little bit what I get in per unit costs, maybe I can make it up big time in volume. And that'll happen across the sectors. But in the meantime, tech is empowering everything. And we don't mean it like in some kind of a moonshot. But in existence today, corporations are doing better, navigating very tough environments, whether it was the financial crisis, whether it was the pandemic, post-pandemic, the supply chain stabilization, getting away from one country's centricity in terms of the global supply chain. All of this technology is enabling a lot of things, both for the consumer as well as for business. And it's a dramatic change. That combined with sensitivity by the Fed, communication, transparency, that we think is, the Bernanke legacy that is still being practiced by Jerome Powell in his own way, has a positive effect.
I keep thinking the economy is not the stock market, and this is not necessarily a stock market that's representative of the broader economy. That really is maybe the Russell 2000 or the banking index, the regional banking index. Does your optimism bleed over to small caps, to the KBW index?
Well, I'd say not necessarily to the KBW yet. We've got to wait for the economy to show a greater sustainability going forward, and not as many concerns in terms of commercial real estate and subprime auto loans and things like that. But what we would say is when we look at this picture, overall, things are getting better. It's being led by the large caps. But if we get to that point where we get to see the sustainability of the economic expansion becoming predominant in the picture, you're going to want to own smalls and mid caps. And you probably want to consider, for instance, we're near market cap agnostic in some ways because our goal is beyond. We're intermediate to longer term investors. And the valuations are ridiculously low in many quality indices of the small caps and mid caps.
John Stolfus, thank you so much. Greatly appreciate it here. The important idea there, the graphic that Lisa put up earlier on radio was really profound about where people still are on an equity index, 4166 now, S&P 500. And Stolfus gets us back to 4,400. But others are still, you wonder if Stolfus is out front of adjusting here what we'll see from Citigroup, HSBC, and Bank of America.
We're running out of time. That's just the bottom line.
It's just a date.
Here. It's a date, and this is one of the
What are you doing
banes.
New Year's Eve?
I'm not sure yet. What are you doing New Year's Eve? You want to hang out and go around trick-or-treating?
No, yeah, really.
A month late, 2 months late.
Yeah, New Year's Eve, that's where it is. Right now, S&P 500, market's lifting a Stolfus way, up 11, up 0.3%.
And coming up, we are going to get at 8:30 a.m. the employment cost index. And again, it sort of goes to this question, do fundamentals matter at a time where people are feeling gloomy? Is good news, bad news, all these fun things that you love talking about.
Thank you for the emails in. I mentioned Charles Gogolak. And this is cool. Charlie Gogolak, I worked with years ago. He was out of Princeton. He played for the Redskins and the Patriots. And his brother, I'm going to say maybe more well-known, was Pete Gogolak. And they get confused. They played one game years ago, 1966, where they kicked extra points, 1 point at a time. And between the two of them, they scored 14 points in one game between the two of them. It was like, the score is like 170 or whatever. But there's, there's a little bit of football history there. He was great. He was the first guy that introduced me to the Bloomberg terminal. And it was
Gogolak
great.
squared?
Yeah, Gogolak, showed it to me. He says, what's this mean? And I said, it means, getting a field goal bond trading is over. Mike Bloomberg is going to narrow the spread on bonds, and that's what Mike Bloomberg and Tom Secunda did.
It has been pretty wild to watch, especially because the tracking of the bond market has been such volatility over the past couple of months. Again, it keeps going back to, you say stocks, and why is the VIX not moving? the volatility has not been in the stock market.
Yeah.
The volatility has been in full faith and credit, which is what's been unmooring a lot of stock traders that want to just feel some sense of stability, and they're not getting it from the market that's supposed to be the deepest and most liquid.
I mean, the Merrill Lynch Move Index 60 is now center tendency 125. It's a double. The volatility
That's
in
where the
bonds
volatility
is.
is.
Did I do okay there?
That's fantastic. Yes, actually, no, but truly, this is the divergence that we've seen of the year. Bonds are more volatile than stocks, and this is new.
Yeah, this is new. What is new? A Fed meeting tomorrow, and then Apple earnings on Thursday. Good news in the equity markets 2 days in a row. It's Bloomberg. Good morning.
I couldn't be more thrilled to be working with Andy Saperstein and Dan Simkowitz, two of my closest friends. They are extraordinary leaders. They're going to drive these businesses.
I'm glad you mentioned Andy and Dan because a lot of questions here around, they were two CEO candidates. Now they're going to be the co-presidents. How do you keep them around? Are you holding them to any lockup periods?
No, they've got phenomenal job opportunities. Andy's co-president. These are phenomenal opportunities. They're high-quality people. These are some of the best jobs on the planet, and, we're delighted to have them.
James Gorman, emeritus chairman, after he did his Tom Keene imitation there with Mr. Peck talking to Shonali Basak here a few days ago. Lovely to have you here this morning. October 30 this year, HSBC, they're in Hong Kong and Shanghai. HSBC sets aside $300 million extra for performance pay. I'm going to suggest in this uproar, everyone is doing this. Am I wrong?
In the last couple of years, we have seen these extraordinary bonus awards go to different executives at the biggest U.S. banks as well. Remember, when you're thinking about HSBC, something else is happening here. It's been a couple of years of really muted activity and therefore poor pay across all of Wall Street. What's happening here at Morgan Stanley is more in line of what we saw over at Goldman and JP Morgan, where there were tens of millions of dollars in special awards handed out, by the way, often contested by shareholders, but handed out to executives to retain their top employees.
Would they leave if they didn't get half this package?
That's the $1 million question, isn't it? Or the $20 million question.
Half the package is $10 million OMG.
Well, you were joking right before we sat down for that interview. James Gorman was joking around with me and saying, there's nowhere to go. Where is everyone going to go? These are some of the most amazing jobs in the world.
It's brutal. I mean, I teared up.
It is quite a moment, right, to see him step down after 14 years. But if there is nowhere to go, what do you need to hand them $20 million for is what I want to know.
And there is a potential lure from some of these smaller upstarts. I'm thinking of Pretium that took a lot of the Goldman Sachs alums away from that whole unit.
Sixth Street.
Right. So there are all of these shops that have started up, and especially if people want to feel like they're starting something anew. So the question is this something that people inside the firm feel like is an indictment of the culture, or is that making a mountain out of a molehill?
Let's look at it two ways. On one hand, these are promotions for each of these three men. One is becoming CEO, one is taking on another unit, and one is also gaining control of another unit and becoming co-president too. So there are promotions, but on the other hand, you do see Mike Mayo at Wells Fargo fighting back here, saying that, does this say something about the firm's culture that they need to keep them around via compensation rather than just the status quo? They are promotions in and of itself. The $20 million packages are essentially the average that all three men get for a year. And so it's $20 million on top of the $20 million that they would give or take get every year.
I imagine it's going to be rough for them to swallow the pill of not getting CEO when they're getting so richly compensated. But there is a larger question around culture and how to continue the culture after James Gorman, who was at the helm for so long through such difficult periods of time. Is that a concern outside of Mike Mayo's point, extrapolating from some of these financial remunerations?
Of course it is. And it's a concern for Morgan Stanley. It's a concern for many other shops that are losing talent at this place in time as well. You think about, for example, some of the very closely held talents that were at Morgan Stanley over the last several years, people that were close to Ted Pick, someone like Sam Kelly Smith, who is going to another hedge fund now that is starting up, or even Colm Kelleher, who was there, of course, his time.
He's got a job in Europe, right?
Well, at a big competitor now, isn't it? And
it's okay.
It's okay. But to that point,
This is Sonali Basic's wheelhouse, folks. Let's clear the air here. Morgan Stanley, 80,000 employees, and a small non-profitable upstart named Apollo, 2,500 employees. We talked to James Zelter in London. Are you telling me Zelter doesn't want to hire one of these beasts from Morgan Stanley
and by
to
the
jumpstart
way,
wealth management?
The special awards at a place like Apollo or even not some of these other private asset managers, they're not 20 million, they're like 200 million.
Okay, well, let's go there. I mean, that's the reality we're talking about. And they got 2,000, rounded up, 3,000 bodies. And Zelter's going, how do we get to 30,000 bodies in grain scale?
He has me wound up. One of the biggest question marks on Wall Street is, what does somebody like a Scott Kapnick have under his belt right now, because he started HPS. It's one of the biggest private creditor managers in the world. Is it going to go public? Is it going to sell? How is he going to create some liquidity for himself in this massive private credit shop that is only taking more share? Remember, this was a JP Morgan employee once upon a time, a Goldman employee once upon a time. How do these new firms keep creating wealth for their employees?
There used to be a hierarchy on Wall Street. And it used to be, you go to the credit rating company first, you get some information out, you get some skill under your belt, then you go to a big bank, then you go to a hedge fund or a private credit shop. That was sort of the trajectory of someone on a compensation scale. Am I correct?
Yeah.
Okay, so now the question is, are there going to be more questions asked about the remuneration at some of these private equity and private debt firms that have gotten very big and are raising money and that are facing some interesting times to deliver returns? And at a bank, if you can be safe and you can be secure and make that kind of money, you'll be challenged more, but it has that stability. How much is this sort of the equation that you hear people talking about?
And I have to say, even at the banks, when Jamie Dimon and Daniel Pinto's awards were contested by shareholders, it was a non-binding vote. They got the money anyways. And so even if money is contested, but to your point here, I think it's worth drilling into that. Private equity, hedge funds. The performance this year is not what it was last year or even the year before that. So then what happens? There is this sense in the market that there could be a much broader shakeout when you look at the private equity industry. I got a tip the other day that said, look at all the people that are losing their junior talent because a private equity firm gets eaten from the outside in and not the inside out. It takes a long time to figure out what the troubles are in this environment. As bankruptcies are starting to mount, they're putting more equity into their companies, and performance is shrinking year over year, and the cost of leverage is going up. Meanwhile, hedge funds have pass-through fees. They're asking their investors for money to pay their talent.
Are you going to see compensation headlines coming out towards the end of the year to get to February bonus? Is that where are we in a food fight for the top 15% of people?
They already are, right? We already see them coming out. Yeah. And by the way, that is paired with the culling, your favorite word here, the 2
to 4% annual culling. I mean, I get it.
Well, hold on a second, because that culling has been a little bit more than culling. I mean, we're hearing about cuts that are being quietly distributed under the hood. How much is this sort of an unequal distribution of wealth, where you have the people at the top who are getting paid a lot more, and people are getting cut on the bottom as AI takes over everything in between?
1,000%. And you have executives, at least privately, making no bones about it. That is exactly what they're doing. And they know they need to do it, because otherwise, how are they going to keep the people around who are making that extra dollar for the bank?
Are you going as a restrictive stock award for Halloween? Is that what you're going?
What does that look like?
That's you go down the box with like a share certificate. You're vested. You can wear a vest.
Right, I'm vesting. I'm vesting. I'll go downstairs and put one on for you for the next segment.
It'll be an RSU where the stock's not issued. Sonali Basak, knowing the difference between RSU and RSA as well. Lisa, on what Mike Mayo wrought in the gossip column this morning. What do you think?
Can I just say, I will get there in a second, but sort of these abstract concepts. There was someone in college who went as a Freudian slip and had a slip-on with all these different, sayings on
Come
it.
on,
It
this
was
is
pretty
family
great.
radio, family television.
It was fantastic. All right, moving on. The whole idea of what Mike Mayo is reaping. There are a lot of questions here, which is how are they going to maintain a culture at a time where James Gorman had such a clutch on that, right? And they needed to bring in and keep some of their top talent, even if they were passed over from the top job. So that was sort of the question is, does this speak to a lack of commitment aside from money, which is viewed as a lesser commitment than some sort of inner passion? But I mean, on Wall Street, isn't it always somewhat about money?
It's all about money, and I adore Mike Mayo. Saw him the other day. We bonded and all that. But to me, I get what he's saying, but I'm sorry. This is the normal game. Everybody goes blah blah blah. McKinsey, fair compensation, and then you go, oh, we have to keep Andrew Sheets, or oh, we have to keep Dominic Constam or Lisa Shallot, on and on.
Well, one person who is much smarter than I, who works in a recruiting field in Wall Street, said the excess is not at the top, it's in the high level middle, where people are replaceable and aren't necessarily driving the culture. And that, I think, is what you're seeing in some of this culling.
The culling, that's what we'll call it. 2-year yield, 5.01%, 30-year bond under 5% as well. Futures up 13, the VIX 19.20. On Israel, on Hamas, Aaron Miller, next. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro in costume preparation. He'll be with us maybe tomorrow. We'll have to see as well. Bramo here. She's going as Toxic Brew. I'm going as Yield Curve Control. It's working out. We're going to trick or treat together. Right now, a lift to the market. Futures up 13 and the VIX nicely under 20. 2 days in a row of better than good ability as well. Michael McKee, with bated breath, we wait to hear about his Halloween costume, but first, employee cost index, Michael, you care about that, don't you?
We do care about that, and this one kind of sneaks in under the radar. One really important number before the Fed meets, not that it's going to really affect their decision this time, but the employment cost index comes in up 1.1%. That's a tick higher than it was in the second quarter. The internet page is overwhelmed at the moment, so we don't have the breakdowns for wages and things like that, but I'll get that for you in just a second, we hope. But it does suggest that employment costs have stayed about the same. Right. Now, let's see whether wages have gone down or not and benefits gone up. But the Fed is looking to see continuing decline in wage gains.
We have Michael McKee, vectors of disinflation. In the EU this morning, other American senses of disinflation. Is there a sense of disinflation in wages, in benefits?
Well, there has been. If you look at pretty much all the measures, the average hourly earnings, we'll get that on Friday. If you look at the ECI, even if you look at what we got in the GDP income numbers, essentially things have slowed down significantly. We were 4 to 5% for quite some time. Now we're in the roughly 4% range for wage and salary gains. Fed wants to see maybe 3 to 3.5%, but they're getting closer.
Okay, so what we're seeing in markets is really nothing much, although a little bit marginally yields a little bit higher, the euro fading a bit from some of the gains from earlier with the disinflation print out of the euro region. And what we're seeing right now, Mike, is basically a shrugging off of yet another better than expected U.S. read on the economy. And this comes as Canada's GDP is tracking back-to-back contractions in the second quarter, the third quarter. We could see a surprise contraction in the euro region. How long can the U.S. remain a lone ship in the storm around the world, continuing with strength and kind of disinflation, kind of not as much as people thought?
Well, if you have an answer to that, I have Jay Powell's phone number for you because he'd like to know as well. I mean, we don't know. There are a lot of reasons you can argue why the U.S. has been doing much better than everybody. Trace it back to pandemic aid. But how long can that last? Nobody really knows at this point because things aren't working the way they used to. Let me throw in here, just because we finally have it, compensation costs, wages and salaries up 4.6% and 5.1% for the year-over-year number.
It's a big number.
So for September 22, benefit costs up 4.1%. So we are seeing some gains there. Private industry workers up 4.3%. Compensation costs 4.5% for wages and salaries.
And you got to move here immediately with that breakdown here with a 2-year yield 5.04%. It was lower earlier. We're going to get back to a 30-year bond 5%. We're not there yet. 4.97% in equity futures given a little bit. I mean, there's a bit of a surprise there, a 4-ish 5-ish wage growth.
Little Halloween surprise.
Yeah. What are we going as? I'm afraid to ask you as William Stanley Jevons or something more?
22 years ago today, there was a murder. 5 years after that, it came back to life. I'm going to go as a 30-year bond.
Oh, very good. As a benchmark.
Yeah, benchmark. Yeah,
very good.
Which sets us up for your guest because he was around then and he remembers that was quite that was a Halloween to remember if you were in the bond market.
We'll do that right now with the dynamics here of moving from a benchmark 30-year in tighter to a 10-year as well. Stephen Stanley joins us right now with Santander U.S. Capital Markets. You are acclaimed for analysis of GDP. How does the bond market affect your analysis?
I think the Fed is overstating the importance of this little backup in bond yields that we've seen over the last month. As we talked about the last time I was here, I see it maybe as a little bit more of an excuse than a reason. I think they wanted to hold off, and that provided them with a convenient reason. Financial conditions have tightened a little bit, but look, as you all discussed, the economy is still rolling at this point. So I think it's wishful thinking that the last 20 or 30 basis points on the bond yield is going to roll the economy over.
But I'll go with this easy question here. It's a cliche, but unfortunately it's apt right now. Are they fighting the last war?
I think it's too soon to say that because, the idea, I assume what you're suggesting is, well, inflation's already licked.
Well, Dominic Constant in Missoula is calling it super restrictive. I got people saying the 5% reality lay on the bond market is a 7% reality in the economy as well. Are they working now? Or they go to the meeting tomorrow in a restrictive milieu?
I think policy is restrictive, but is it restrictive enough? I mean, until the economy actually slows down, until inflation really comes off, it's hard to say that. And so I think that's why that at a minimum they're certainly going to want to keep their options open. They've signaled another pause, but Powell has certainly kept the door open to further hikes.
So I'm going to throw this question at you, what I was asking before, which is how long can the U.S. continue surprising to the upside with economic data and showing momentum at the same time that you see Europe running into recession, Canada coming out recession, around the world, a lot of pain?
Maybe not to be overly glib, but basically forever, because the U.S. is a domestically driven economy. And I think economists and particularly the Fed have systematically over the years overestimated the importance of the global economy for the U.S. economy. We're, between 10 and 15% of our economy is trade, whereas for most of the other major economies, it's 30, 40%.
Okay, I'll challenge that in one way.
Okay.
And this is something that a lot of people have been talking about, and I would love for you to push back if this is the case. People say that the international transmission mechanism is the U.S. yield, is how many international buyers are going to be coming in and picking up treasuries at a time where the Bank of Japan's not going to be buying, where you're going to have, or not going to be really pushing investors out of that nation's asset market, where you have certainly around the world yields going higher and China not buying. How much does supply change that narrative and create more of an international transmission mechanism than ever before?
Yeah, that's an interesting angle, actually. I think the root of the problem there, of course, is the fact that we're running such large deficits. If we had a smaller deficit, then this wouldn't be so much of a problem. But the fact that the Treasury has to borrow an extra $2.5 trillion a year, they need demand anywhere they can get it. So that actually does bring a good point, which is that it feels like the international community has pulled back a little bit for various reasons, and I think that's part of it, a piece of why yields have backed up recently.
Well, Mike McKee summarized this for us. We've heard this twice today on surveillance. Gilles Moek of AXA and Stephen Stanley of Santander agree the United States is a relatively closed economy. Are we an economy of fiscal stimulus, thinking of refunding and all the other debates, versus Europe in austerity stimulus? I mean, are we living a fiscal stimulus that makes us different?
Well, yeah. Well, I mean, as Chris says, Steve says, we're a sort of closed economy. We don't have to worry necessarily about what's happening in Europe as much as Europe has to worry about what's happening in the United States and China, their biggest trading partner. And so we can stimulate the economy and we can run deficits for a lot longer. Nobody knows exactly how high or how long, but it doesn't have the same kind of effect. Interesting to note where we are with yields these days is where we were in the 1990s when we were growing at 4.5% a year. So can we live with this? I mean, for now, we can.
Right. Stephen Stanley with us. So I'm not going to go higher for longer, but just pick one of them. Are we going to go higher or are we going to go longer?
Well, I think the more important thing is the longer part. They may go one more time. But we're pretty close to the end, so I don't think the higher part is the more important of the two right now. I think the more important issue is how long are they going to stay
Can the American economy equilibrate through a higher nominal and real rate? Or almost equicalibrate, I would almost say.
Yes, I think we're in the process of that. I think that, in my mind, the neutral rate is anywhere from 50 to 100 basis points higher than it was before COVID.
So give me a 10-year real rate, which is going to be a run rate.
I think it's probably 1 to 1.5%, something like that.
Okay.
When we look right now at the data that we're getting this week, you said that the Fed seems to be looking for an excuse, and it's not really that they're so concerned about what you called this little backup in yields. So what data could make it difficult for them to use the backup in yields as some sort of an excuse?
Well, boy, we're really testing that, right? Because since the September meeting, we've had a blowout payroll number, a high inflation number, stronger than expected consumer spending, and now we get a firm wage number. So you pretty much a clean sweep, and yet they're clearly going to pause. So I think it's going to have to be not so much a particular data point, but a duration of a stretch of good data. If we continue to see good data for another month or two, then, it just becomes increasingly compelling.
So tomorrow, based on what they say and based on the economic data, what are the chances, from your view, that they've got to go significantly further than currently markets are pricing? Yeah, so significantly further is a really important part of that question. Because as I said, my base case, I have one more hike, but that's, whether they do one more or not, it's not that important. But there is a scenario where inflation reaccelerates and they end up having to go multiple times. I think that's the scenario that you might have in mind. To me, that's the biggest risk factor. I see that as a bigger risk than the risk that the economy slides into recession and they end up easing much sooner than people expect. But it's at this point, for me, it's a risk scenario, not a base case.
Is it true you're going for Halloween? You're going as dot plot?
That's a rumor. I can't confirm or deny that.
You got Bullard up at the tippy top of your head?
There you go.
Okay.
I have a lot of room on my head for dots.
So do some of us. Also, John Ferro going as Yul Brynner. I don't know if you knew that. One of the Magnificent Seven.
Well, I look forward to seeing that costume.
Good to hear from you, John. It was good to hear. Stephen Stanley with his chief U.S. economist at Santander and just outstanding on American economy. We got to get him back to talk about 5% GDP and all that. What do you think of the markets here? They come in a little bit off the McKee's gloomy eco benefits, wages, and all that.
It highlights the nervousness, the fact that the NASDAQ has now turned slightly negative, the fact that suddenly, again, good news is bad news. If, higher wages is good news for everybody, the rank and file, but we're looking at a scenario that Stephen Stanley laid out really well, which is that the risk of reacceleration is greater than the risk of recession.
Red and green on the screen. NASDAQ a little bit red here. Standard & Poor's 500 up 5 points right now. I'm going to call that 0.1%.
Michael McKee's still here with us, parsing through the data, understanding the sort of machinations behind it. How durable, how sticky are some of these employment costs that are going up, leading to, yes, higher wages, but also perhaps margin compression and basically margin compression.
Well, they've been relatively sticky because there's almost no change in the quarter-over-quarter numbers. The wages and salaries overall up 1.2%. That's an acceleration from 1% before in the second quarter. And then in the private industry, 1.1% after 1%. So we're still seeing wages go up at a little bit faster pace. Benefits go down a little bit in cost, but part of that is timing. But the point is we are seeing sticky wages at this point, and it'll be interesting to see what happens with hourly earnings on Friday.
November 1, a Fed meeting. Jerome Powell's going to have to be saintly, to say the least. What does he not want to say in your press conference?
Well, he definitely doesn't want to say recession, and he doesn't want to give the idea that inflation is going to accelerate. He wants to be on the progress bandwagon. But I think the biggest message he wants to leave people with is that the Fed might be done, but we're not going to say that because we don't want the markets to price that sort of thing in.
Michael McKee leading our coverage tomorrow on the Fed. Again, the former Vice Chairman, Richard Clarida, will be with us as well. Lisa, red and green on the screen. I mean, that's all there is.
The fact that good news is still bad news tells you everything you need to know. And it's been on the margins. It's not a massive move yet, but just wait. We get the consumer sentiment survey coming out later, right? I believe at 10 a.m. And housing data coming up on the open. Kathy Jones of Charles Schwab, Troy Gajewski of FS Investments, and Aaron Brown of PIMCO ahead of that key Fed meeting, but also the Treasury refinancing agreement, which might be actually more important.
I'm all over that.
We know there's a lot more that needs to be done, but it's because of American leadership on the ground and American convening power that we're able to get that aid in and try to see if we can sustain it. We're working very hard at this. We're going to repeat it. Every single innocent life lost is a tragedy. Every one, whether it's a Palestinian life lost or an Israeli life lost. Every one should be prevented.
John Kirby at the White House, the National Security Council spokesperson, but far more Admiral Kirby, who understands how ships sitting in the Eastern Mediterranean are at risk. We say good morning to all of you. Bloomberg Surveillance from New York. John Ferro on assignment. Lisa Abramowicz getting ready for the 9 o'clock hour here off of ECI, and the markets pulled back a little bit. A Fed meeting tomorrow. Apple earnings the next day off of the announcement we saw last night from Apple, their marketing campaign on new products as well. We're also considering, a data check here, and I'm going to go to oil right now, 88.02, quiescent, given the tragedy that we see in the Eastern Mediterranean. This should be a 2-hour conversation. I can't say enough about the work of Dr. Miller. He is Aaron David Miller. He's a senior fellow of the Carnegie Endowment for International Peace. The shingle is from the University of Michigan, Definitive in International Relations. And he wrote a book in 2008 that was shockingly prescient 15 years on about the mess we're in the Eastern Mediterranean. Aaron David Miller, thank you so much for joining us this morning. When you wrote your masterpiece in 2008, did you expect the tragedy we're living now?
I expected, John, that an unresolved Israeli-Palestinian conflict driven by a proximity problem. Israelis and Palestinians are living on top of one another. And frankly, I think it was Mark Twain who said that proximity breeds contempt and children. I figured that this conflict would endure. It would go through periods of accommodation, perhaps, as it did, but also periods of conflict that we've seen. But I think, I for one, I'll put myself at the top of the list, never anticipated the kind of trigger to this particular phase of the Israeli-Palestinian conflict. That is to say, what happened on October 7 with Hamas's brutal and savage attack and its willful and intentional indiscriminate murder of men, women, and children. I did not anticipate that, and clearly in probably one of the two greatest intelligence failures in the history of the state of Israel, neither did the Israelis.
Aaron David Miller, Robert Gates writes a piercing essay in the New Foreign Affairs magazine. I read every word of it, the former defense secretary and head of CIA, on a dysfunctional America, a dysfunctional superpower. You are someone that straddled the line, I would say, within the politics of Washington. What's Aaron David Miller's best practice now for the Biden administration?
When it comes to this particular crisis, remember, we now have an arc of crisis. We have a major crisis in the Middle East with the potential of escalating even further. If you end up with an Israeli-Hezbollah war, you're going to see, not to mention the prospects of Iranian involvement and direct confrontation between Israel and Iran, which would lead to spiking oil prices and plunging financial markets and even more uncertainty with respect to the global economy. You've got Russia's invasion of Ukraine. You've got tensions in the Indo-Pacific. Look, I've long believed, I'm a follower of Reinhold Niebuhr, proximate solutions to insoluble problems. this is a world that cannot be resolved. That is to say, I'm not sure there is one conflict out there you could identify that had a definitive or comprehensive solution. This is all about smart management and a judicious and very balanced view of the projection of American power in areas that, in fact, we can and affect. But no, this is not a world to be redeemed or resolved.
Right.
It's one to be managed if we're lucky and smart.
Aaron David Miller, Robert Kaplan's new book, The Loom of Time, is my book of the year. It's just a sprawling treatise from Morocco all the way over to Persia, indeed on to Afghanistan as well. And what permeates Kaplan's realpolitik is the basic idea that we have a human rights-led foreign policy. Is our human rights-led foreign policy at risk, given what we see in the Eastern Mediterranean region?
You know, Kaplan's a really smart guy. Based on my experience, John, working for Republicans and Democrats over a 30-year period from Jimmy Carter to Bush 43, I don't think we have a human rights-based policy. In fact, human rights, democracy, promotion, responsibility to protect, intervention to prevent or even respond to mass killings, from the Holocaust to Cambodia to Rwanda to Darfur to South Sudan to Syria. Where has the United States been with respect to the protection of human rights? I'm not saying that is a role we need to play and can play all the time, but I think human rights is a factor. But based on my experience from Carter to Bush 43, it's rarely at the top of our agenda.
There's been shades of isolationism there, even off of the shock of Jimmy Carter and the Iranian hostage crisis in, I believe, 79. What does our new isolationism look like?
I'm not sure. Well, clearly, we're not there now. I think the America First notion, although I think that largely would translate into putting America last, we've got to find the right balance, John, between doing too much in the world and not doing enough. One of my former bosses, Madeleine Albright, referred to the United States as the indispensable power, and I remember what de Gaulle said about the cemeteries of France. They're filled with indispensable people. We can't be the indispensable power if indispensability means that we need to be everywhere to everyone all the time. We have a dysfunctional political system. That's the strength, by the way. Repairing that is critically important to our capacity to lead, not by what Joe Biden says, not by the example of our power, but by the power of our example. There is something to that.
From where you sit in international relations, is our Pentagon properly funded, and specifically, does the Navy have enough ships and submarines?
Probably no and no. I suspect, even though there are some who argue that our defense budget is way out of whack. It'll be fascinating to try to see how we're going to resource going forward, because each of these problems I referred to, what you're seeing in the Middle East right now, Russia's war against Ukraine, which seems to be forever, and the prospects of a rising China in the Indo-Pacific, all of these things have to be properly resourced. And that's a concern that I have, given the nature of our domestic politics.
One final question, Aaron, to circle back to your 2008 treaties. There is a much to promised land. What should we advocate to Israel and the Palestinians in this November?
A lot of people I respect, John, believe that the so-called two-state solution has gone the way of the dodo. I understand the argument, but frankly, it's the least bad solution to this conflict. Israelis and Palestinians need to separate from one another through negotiations. There's no precedent that I can think of two national movements, one a state, a non-state actor seeking to become a movement, living happily ever after under one roof. It's Cyprus, Lebanon, Syria, Iraq. The beat goes on. So it's just a hop, skip, and a jump to understanding that if, in fact, you can have anything resembling a conflict-ending solution, I'm choosing my words very carefully here, you really do need to have separation through negotiation, maybe into a confederation at some point, but you need to satisfy the political, territorial, emotional, psychological, and religious underpinnings of this conflict. The only thing that does that, in my judgment, is to separate through negotiation State of Israel living peacefully next door to a Palestinian polity. That, to me, is the only way to even begin to think about fixing this.
Aaron David Miller, thank you so much for the brief. Hugely valuable with the Carnegie Endowment for International Peace. And I really can't say enough, folks, about the overview there from Dr. Miller versus the immediacy that we see from Oliver Crook in Tel Aviv and our Anne-Marie Horton in Washington as well. Again, look tonight to balance of power as we go into a difficult Eastern Mediterranean evening. Tomorrow at 1:30 p.m., Bloomberg Surveillance. It is our special, The Fed Decides. Honored to have Richard Clarida with us with his perspective. Honored to have Jerome Powell with us at timely press conference as well. Michael McKee leading our coverage. Futures up 7, green on the screen, VIX 19.39. This is Bloomberg Surveillance.